So very good evening to all of you students. Students, we will start today with the IFOS part. But before that, there is one particular position which we have to consider about the last session. That very big question, students, that was there. Question number, question number 8 or 9. We'll deal with that first. And students, I'll tell you, immediately after this, in IFOS, we will see the same real estate transaction because there is a very big provision on the gift tax under the head IFOS. So we will be considering that particular part, students, as well, immediately after this, so that you can have an interlinking between both the sides. Both the sides, what I mean? It means that from the seller point of view and for the receiver's point of view. So that you are aware that this is a position that we took for the transferor under the head capital gains. And this is a position that we have to take for the transferee under the head IFOS. So that interplay fantastically will happen, students, under this particular context. Similarly, students, we have also discussed, if you remember, in the context of business reorganization, at that point of time, there were discussion on the dividend particular part that also have emerged. Like, for example, at the time of liquidation, I told you that when the assets are received by the shareholder, the first particular tranche of that amount that has been received goes towards IFOS under the head deemed dividend. And only the balance is what is the amount considered as a full value of consideration to be considered for the purpose of computation of capital gains in the hands of the shareholder at the time when the liquidation has taken place. Now, students, coming back to this particular case study, students, and I'll just first share this notes. Just allow me a minute. Students, very quickly, I'll have prepared this particular thing because it's a very big question. You will not be getting, students, you will not be getting such big question, but this question is comprehensive enough for you all to do a revision in one question, all the concept which is involved in that real estate transaction. One of the beautiful question. So students, let's quickly run through the question again in this particular context. And then I've prepared a timescale diagram because the facts itself was having much of the data that it was important that I prepare one particular timescale, a big timescale diagram I have prepared for this one so that I could explain to all of you the things easily from this particular segment as well. So I hope that this slide is seen by all of you, and then there is a chart which is there, which I have prepared for all of you. Let's start, students. So here is a case of, again, I'm repeating, students, you don't get this kind of a big question involving each permutation and combination in the examination, but you will be getting some part of it in the examination. So in one particular question only, multiple aspects get revised. That's the beauty of this question. So full integrated question which is there, Harish Malhotra, a resident individual, inherited through the following chain. Now, students, Harish Malhotra is the ultimate SSE, the son who finally has transferred that particular asset. So he's the ultimate SSE. Yeah? May I say grandson in this particular question? His grandfather had mortgage or residential property. Harish's father, Mr. Dev Malhotra. Now, grandfather name is not mentioned here, only grandfather. And what is the fact given? That the grandfather has mortgaged the property. Two names have been given in the question. One is of the son, Harish Malhotra, and his father, Dev Malhotra. Harish's grandfather's name is not mentioned. Only fact they have mentioned is that the grandfather has mortgaged the residential property. Now, Harish's father, Mr. Dev Malhotra, purchased it on 10th of June 1998, subject to the subsisting mortgage. Obviously, Dev Malhotra's father has created the mortgage, and therefore Dev Malhotra happened to receive that particular asset having a mortgage in that. So obviously that is one of the points that you should always bear it in mind. See the next line. The rupees 9 lakhs paid by Dev was consideration for the equity of redemption. Now, this is a phrase which was used in a case law, equity of redemption. It simply put, what is my value, what I have received. Please understand one thing. Once you do a mortgage of a property, then mortgager who has done the mortgage, mortgagers will have an interest now in that property because he is the owner of that particular property. And the bank who has given the loan will have a mortgagee's interest in that particular property. So therefore, the 9 lakhs which was there was as a consideration for the equity of redemption, means it is his particular value, mortgager's value, which Dev has got it in that particular property. But please understand, he has only a limited interest, and that is of the father who has created the mortgage. After that, it is a mortgager's interest which got passed on whom? On Mr. Dev Malhotra, his son. So 9 lakhs happens to be his particular value, which he has inherited in that way, which is only limited to the mortgager's interest. That is what this sentence means. So this is why I'm just giving you, so that you should not, in the examination, if at all it comes like this, you should only understand that this is a value of the father, which is now limited only to the extent of the mortgager's interest. Okay, because the father has created the mortgage, and hence it is the mortgager's interest which is there of rupees 9 lakhs that he has inherited now. Who has inherited? Mr. Dev. So the 9 lakhs was consideration for the equity of redemption to obtain clear title. Okay, that is his interest value is 9 lakhs. He separately discharged the grandfather outstanding mortgage of 15 lakhs. So now mortgage's interest 9 lakhs. Mortgagee, which is the bank, by paying off, he has now acquired the mortgagee's interest also. So now the total cost of acquisition for Mr. Dev will be 9 plus 15 in this case. Further, they have written, students, they've spent rupees 9 lakhs on improvement in March 2000, students. Remember one thing which we discussed, if you can recall, that any particular improvement that you may have done before 1st April 2001, that improvement has to be ignored. So any improvement, students, done before 1st April 2001 will have to be ignored, and therefore this improvement data which has been given to you will have to be ignored in this case. Now, continuing further, 1st April 2001, the fair market value was rupees 21 lakhs and the stamp duty value was rupees 19 lakhs. So students, we have seen in the last session the provision itself, where as on in the case of in the case of any other property other than the immovable property, we'd only take the fair market value as on 1st of April 2001. But if at all, students, if at all we have the immovable property which has acquired before 1st April 2001, then in that particular case, the fair market value as on 1st April 2001 will have to be compared with the stamp duty value. With the stamp duty value, and only one of the two has to be selected, not the both. And that what has been selected in this two comparison will then be compared with what? With the actual cost, and whichever is higher will become the final cost of acquisition. So which is the first two comparison that you have to do? The fair market value as on 1st of April 2001 will be compared with the stamp duty value as on 1st April 2001. And after that, in this two, whichever is the lower amount, in this example, students, it is a stamp duty value is the lower amount. So you will pick up stamp duty value from this comparison, and then you will compare with the actual cost primarily, and the actual cost will be compared with this qualifying amount, and whichever is higher will become the final cost of acquisition. They forfeited an advance of rupees 2 lakhs in August 2008 in a failed negotiation. Now, students, we also know that subsequently, the asset was inherited by Dev's sons, Mr. Harish. And then we also know that in the case of a subsequent inheritance of an immovable property, any forfeiture has happened by the previous owner. Any forfeiture that has happened by the previous owner, that forfeiture amount has to be ignored. So the final assessee would be the grandson. Who is the grandson? Harish Malhotra. Harish Malhotra's father is Dev. Dev has forfeited some advance money. And we know, as per the provision, any amount which is forfeited, any advance money which is forfeited by the previous owner, that advance money needs to be ignored. That forfeiture needs to be ignored. So students, in this question, two things will be ignored. And just keep this as a one particular note. You should always keep it in mind. Two things are ignored. One is improvement done before 1st April 2001 will be ignored. What is the first one? Improvement which is done before 1st April 2001 will be ignored. And the second thing that needs to be ignored, students, is the forfeiture of the advance money done by the previous owner. Forfeiture of the advance money done by the previous owner will also be ignored. It is better that, students, this 2 points, you need to just take a note of it somewhere in your notebook. Shall I proceed further, students? Perfect. After that, students, what is happening? Harish has inherited the property on 1st of July 2010. That is a grandson now. Harish forfeited an advance of 1,50,000 in Jan 2013. So it is before 2014 that the forfeiture has taken place. And if it is before that 2014, 1st April 2014, then what we will say, students, then in that situation, the amount which has been forfeited will be reduced from the cost of acquisition in computing the capital gains for Mr. Harish, who is the grandson. Harish spent rupees 7,52,000 on qualifying improvement in tax year 25-26 last year. So last year would be the improvement that he has done. Will it be considered? Yes, it will be considered. He forfeited a further advance of rupees 3 lakhs in July 2026 when another negotiation failed. So July 2026, students, in the current tax year, he has forfeited an amount. This amount which is forfeited will be chargeable under the head IFOS. Harish sold the property on 15th of December 2026 for rupees 90 lakhs. Stamp duty value on that date was rupees 1 crore 5 lakhs. So this would be the comparison for full value of consideration. That 110% of the consideration received will be compared with the stamp duty value. And if the stamp duty value is higher as compared to that 110%, then the full value of consideration is the stamp duty value. If the stamp duty value does not exceed the threshold limit, then in that case, the full value of consideration is the consideration amount received. Transfer expenses was rupees 2 lakhs. This will be reduced. Harish has other normal rate of income in this context of rupees 50,000 and no chapter 8 deduction, students. Now, students, one thing, just if supposingly here, if you have to go with this one, if you have to calculate a full tax liability, if you have to calculate, students, in this case, full tax liability, then obviously when the question is like this, and then they don't tell about an individual that whether he has opted for the alternate tax regime or not, whether he has opted for the alternate tax, whether he has opted for the normal provision or not, then we know that it's a default regime that will be applicable. And what is a default regime? It is the alternate tax regime is a default regime for the individual and the HUF. So therefore, if the tax liability has to be computed with this kind of a question, we will definitely will take into account only the default tax regime. On that backdrop, students, here the facts I'm just giving again a particular thing. It was a one big fact which has been there. So just to again run through the timelines which was there in this particular question. The timeline, students, Dev's father, he created a mortgage, and then somewhere in 88, they've inherited the asset. The equity redemption or the mortgage's interest was how much? Rupees 9 lakhs. Thereafter, he discharged the mortgage interest by the father and he paid rupees 15 lakhs. So we know that this would be added to the cost. So therefore, this will be added to the cost. They've spent rupees 4 lakhs on improvement on March 2000. Any improvement before 1st April 2001 to be ignored. Then 1st April 2001, FMB was this much, SDB was this much. So we'll take 19 lakhs only to be considered over here. And this 19 lakhs will then be compared with the actual cost. And the actual cost we can see it is already 9 plus 15, which is 23 lakhs. So whichever is higher, 23 lakhs will be compared with what, students? Sorry, 24 lakhs. 24 lakhs will be compared with rupees 19 lakhs. Whichever is higher will become the cost, which is 24 lakhs. Thereafter, students, they forfeited rupees 2 lakhs on advance money. This happened in 2013. This happened, students, in 2013. Sorry. This happened in 2008. So 2008, this happened. So, but he's a previous owner. And because he's a previous owner, this will be ignored. Because Mr. Dev, the father, he's a previous owner, therefore it will be ignored. Harish inherited in July 2010. And thereafter, Harish forfeited rupees 1.5 lakhs in this context. So this forfeiture amount, will it be reduced from that 24 lakhs, which is the cost of acquisition? Will it be reduced from that rupees 24 lakhs, which is the cost of acquisition? And the answer is yes. Thereafter, students, improvement has been done in the last tax year, which is 25-26. Whether this improvement will also need to be considered? And the answer is again yes on that. Students, improvement will be considered in this case. Advance money forfeited. Advance money forfeited, students, is rupees 3 lakhs. In the current tax year, students, this will go under the head IFOS. So this will go under the head IFOS, taxable separately. And then thereafter, in December 2026, it has been sold. Now, students, first of all, we need to decide the nature of the capital asset. The nature of the capital asset. So the nature of capital asset, students, in this case, when the asset has been inherited, we know that the period of holding of the previous owner will be clubbed to decide whether it is long-term or short-term. Now, students, one point which you should always bear it in mind, that you should bear it in mind, that when you do the clubbing of period of holding, you are not only supposed to club the immediate previous owner, but all the previous owner earlier, if the asset was devolved in succession through the inheritance route, which means that no particular earlier transferor were subject to any capital gains tax. And why is it so? Because of that section number 70. Because of that section number 70, no particular previous owner has suffered any capital gains tax. If they have not suffered the capital gains tax, then we will try to then club all the period of holding of that earlier owners, and that will then decide what would be the tenure of that particular long term of that particular capital asset. And if it is more than 24 months, it becomes long term. Apart from that, students, what about the cost? Cost again will go and we'll trace it back to the last owner, and which is rupees 9 lakhs. And then add to that, we already have considered we have arrived at the cost up till 2001, which is 24 lakhs. Isn't it? And from that 24 lakhs, the advance money which was forfeited by the son, which is Mr. Harish, which is 1.5 lakhs, this would be reduced. So the net cost would be available to us. And then we will do the indexation. If indexation, students, again, I'm repeating this part. This indexation will not be done in the computation of total income. This indexation will be done in the computation of tax liability only. this indexation will be done only in the computation of tax liability. So students, let's run through this particular part quickly in terms of the solution and then move on in this context. Now students, after this question, students, you will find the same particular small things. In fact, this question should have been last, because in the subsequent question which I have seen, the adjustment that we are going to deal with it in this question, you are going to find in the subsequent small question which has been prepared. So I'm not dealing with those small questions now, because those adjustments we are going to cover it up over here itself. Let's start, students, over here. So various issues have been considered, students. In this entire issue, I am not going to deal with the TDS part. Students, TDS, once we are done with it, at that particular point of time, we will discuss it. TDS, once we are done with it, at that particular point of time, we will discuss it. But simply put, students, any TDS which has been deducted by the buyer, that credit the seller or the transferor will get. At least that much knowledge we all have. The buyer, primarily the receiver, the buyer who is deducting the TDS, the seller accordingly, when he will compute his tax liability till HEC, thereafter the TDS credit, TCS credit, advance tax credit has to be given. So that credit placement is after the transferor has calculated his tax liability till HEC. After that, he claims for the credit of the TDS, TCS advance tax or self-assessment tax, as the case may be. So let's have a look, students, further in this regard, in this context. Students, over here then, please have a look. Let's take one by one, each and every aspect. Over here, father's purchase cost 24 lakhs. We already discussed, students, how we have arrived at. I have told you already. Between that 19 lakhs, that was compared with the 24 lakhs. Higher of the two, which is 19 lakhs, was selected from this comparison. This became the qualifying amount. And this qualifying amount was compared with the 24 lakhs, 9 plus 15. So therefore, higher of the two, 24 lakhs became the final answer. Then advance money forfeited by the son, not the previous owner. This is what was reduced. And finally, the cost of acquisition was 22 lakh 50,000. Now, if we do the indexation in the tax liability computation, students, in the tax, not in the total income computation, in the total income computation, this is the only cost of acquisition that you are supposed to remove. What about the cost improvement, students? Improvement, any idea behind this? The son, Mr. Harish, he has done the improvement in the last year. The asset is a long-term capital asset. The asset is a long-term capital asset. So my question to all of you is that whether the indexation benefit, will it be given to the improvement also? Or you will ignore the indexation on the improvement because the improvement was just last year. The improvement was not beyond 24 months. What is your particular answer, students, in this case? Whether we should be giving the indexation for the improvement that happened in the last year, or we should ignore the indexation because the improvement tenure was not beyond 24 months. What is your answer, students, before we start looking into the solution? Please let me know. Indexation, when I say, is the indexation is only to be considered in the tax liability question. Okay. So students, what do you think of it?
Good evening, sir.
Yep.
Sir, what I think, sir, when we provide indexation benefit, we should consider the actual assets, nature of assets, rather than the improvement part. So, actual asset is long term, so we will consider the indexation improvement part
Perfect.
as long term.
Perfect. So therefore, students, you have to only go by the nature of the capital asset. If the capital asset is a long-term capital asset, students, if the capital asset is a long-term capital asset, then by default, the indexation has to be given in this context. So you are not then supposed to see, but sir, the improvement happened in the last year, doesn't matter. If the asset is a long-term capital asset, even if the improvement may have taken place in the last year, the indexation benefit for that improvement has to be given. And that exactly is the point, students. So now then, in this context, if you see very carefully, the cost of improvement over here, in this regard, any improvement which is done, students, any improvement which is done before 1st April 2001 will be ignored. So father has done improvement somewhere before 2001. In 2000, he has done the improvement. That will be ignored. Harish qualifying improvement in tax year 20, that will be considered. So my improvement is how much, students? 7,52,000. In computing, students, in computing my total income, I will only reduce this 7,52,000. Indexation, again, I'm repeating, is an concept which will be considered only in the tax liability computation. Okay. Now let's proceed further, students. Treatment of forfeited advances. Forfeited advances. Only SSC, which is Mr. Harish, the grandson, only his forfeiture will be considered. Any forfeiture that may have happened before, that will be ignored. So therefore, Harish forfeiture will be considered. So Harish has done forfeiture 2 times. One in 2013, which we will consider to reduce the cost of acquisition, which we have already reduced it. And the second, which is in the current tax year. In the current tax year, it will be charged under the head IFOS. So that is what the treatment is, students. I'm not again discussing the same. This is particular table. The improvement which is done by the previous owners will be ignored completely. Now let's come to the full value of consideration, students. Full value of consideration is a simple one, students. Actual consideration is 90 lakhs, which you can see. 110% becomes 99 lakhs. Stamp duty value is 1 crore 5 lakhs. So full value of consideration would be the stamp duty valuation, which is 1 crore 5 lakhs. So this is precisely what will be your FVC, less expenditure incurred wholly and exclusively, which is given to you in the question 2 lakhs. Then you get the net consideration of 1 crore 3 lakhs. Cost of acquisition 22 lakh 50,000. Cost of improvement 7 lakh 52,000. Okay. Long-term capital gains. This is what will enter into, students. This is what will enter into your total income computation. Long-term capital gains of 72 lakh 98,000. Now, may I say that Harish therefore has got two incomes. One is this LTCG of 72 lakhs 98,000, and second is the IFOS of rupees 3 lakhs. These are the two particular income that will be a part of the total income in this context. Now, therefore, if you see, students, now come the real calculation of tax liability, students. If you see one thing very carefully, students, in this case, there is one more income which is there. Let me see. This I have missed in the question. Let us see. Okay, yeah. Last line, students. Harish has other normal income also. So there are two income, two IFOS income. One is 3 lakhs, another is 50,000. So total IFOS income, students, is how much? 3 lakh 50,000. LTCG is how much? 72 lakhs 98,000. Now, students, tell me one thing. So total income is known, 72 lakh 98,000 LTCG. IFOS is 3 lakh 50,000. So that will give you the total income. Okay. Now I told you, students, you have to calculate a tax liability. Okay. This point already we have discussed, and this point is also coming in the next question. Students, what is that? He is in a default tax regime. The slab rate starts from 4 lakhs. So if you see the normal income chargeable at the normal rate, not the special rate of 197, 198, 196, 197, 198. So the normal income, students, which is chargeable to normal rate is only 3,50,000 rupees. And your slab rate is 4 lakhs. So there is an unabsorbed basic exemption limit of rupees 50,000. Question therefore to all of you is whether that unabsorbed basic exemption limit of 50,000, will that be reduced from the long-term capital gains or not? Will that be reduced from the long-term capital gains or not? To that the answer is yes. The LTCG, students, that is there with you, or which is chargeable under section 197, or even the other special rate of tax that we discussed, 196 and 198. Unabsorbed basic exemption limit, students, will have to be reduced from these three special rate of tax. This point we have discussed earlier also. This is coming in this question as well, and this is coming in the subsequent question as well. So therefore, this 50,000 of the unabsorbed amount would be reduced from that 72 lakhs 98,000 of your LTCG. And then on the net LTCG, we will then check out the normal rate of 12.5% without indexation. And if you have to do the indexation, students, then accordingly, we will have to consider the revised long-term capital gains. And on the revised long-term capital gains, we will again reduce that 50,000 on that revised long-term capital gains, because that revised long-term capital gains is an option available. of indexation. So you will have to calculate the revised long-term capital gains after indexation, and whatever is the revised long-term capital gains that you will get from that, you will reduce 50,000, and after that, the net amount of LTCG will be charged to 20%. I hope that this point is well taken by all of you students. So if I have to just quickly run through this particular part with all of you, see the statement which has been given. Total income is over. I come to the tax liability part, students. Now just over here, see, we already have got this particular part. This is a net sale consideration that we already know. 1 crore 5 lakhs minus 2 lakhs was the expenses of transfer, isn't it? 1 crore 3 lakhs, which was this particular part. And then thereafter, students, what is the index cost of acquisition? Index cost of acquisition is this much. How did we calculate the index cost of acquisition? The cost of acquisition, which is 22,50,000, into the CII of the year of transfer. Which is the CII of the year of transfer? Tax year 26-27. The CII is 384. And divided by which year you are going to take? The year 2001-2002, which is 100. So that will give you what? The index cost of acquisition. And then the index cost of improvement, students, in this context is this much, 7,68,000. How you got this 7,68,000 index cost of improvement? If you see herein, 384 is the current tax year divided by the last tax year CII. So therefore your amount becomes 7,68,000. And if you reduce, students, can you give me the answer? This LTCG, how much is the LTCG in this context herein? So 1 crore 3 lakhs minus to that 94 lakhs 8,000. What is the 94 lakh 8,000? This too. Index cost of acquisition and index cost of improvement. So this gives you what? The total indexed amount of 94 lakhs 8,000. And then finally, students, you get what? Indexed long-term capital gains of 8,92,000. Now here, students, without putting much of brain, I know that this 20% is lower as compared to the earlier one. This would be somewhere, students, what? 9 lakhs 24. Around 1,80,000. Can you give me the answer, students? Okay, just hold on, students. Tell me before that. I told you this long-term capital gains, will that be eligible for reduction from the basic exemption limit of 50,000? The long-term capital gains of 892, I told you already, even this long-term capital gains of 8,92,000 will be eligible for reduction from the basic exemption limit. So therefore, the basic exemption limit unabsorbed 50,000, this unabsorbed 50,000 will be reduced, and then finally your long-term capital gains, the indexed base, the LTCG, which is the index base after the reduction of base exemption limit is 842. Of this you will take 20%. Of this, students, you will take 20%. So if you can just quickly give me the answer, if you can, students, quickly.
1,68,400.
1,68,000?
68,400.
400. Okay, Rama. 1,68,400. Obviously, students, this is very less as compared to the earlier figure, which we know. Students, how much was that? Earlier was very higher amount in this case. The LTCG was this much in this case. Was this much. And from this, I have reduced 50,000 more LTCG because the balance 350 has gone in that base emission limit, and then balance is the unabsorbed amount. So obviously this is somewhere around 72 lakhs 48,000, and of that 12.5% is a very higher amount, isn't it? So this is quite a higher amount, somewhere between 7 to 8 lakhs. So this
9,06,000, sir.
How much?
9,06,000.
9,06,000. Just imagine this. So obviously he will have to this kind of a property. The assessee definitely will take up the option of the indexation in calculating his tax liability. And then, students, what finally he'll get it? if you calculate his tax liability further in this context, you know of that, he will take up that the tax as per this plus the surcharge. Obviously, now his total income, students. Now, how much was his total income? Now, again, I'm repeating this part. This should not be mistaken, students. If you see the total income, will you take total income, students, on what basis? The total income which is without indexed amount. Without indexed amount, what is his total income? So, without indexed amount, his total income, is it? Now, this is, students, going at what particular thing? 76 lakhs 48,000. 76 lakhs 48,000. Now, is it more than 50 lakhs? Yes, but less than 1 crore. So the surcharge that would be applicable in this particular case, students, would be at 10%. The surcharge that would be applicable, students, would be at 10%. So you'll add 10%, and then 4% would be the HEC in this case. And finally, what can you just give me quickly this amount after HEC? 168,400 plus 10% and plus 4% of HEC. HEC is applied on the combined amount of tax and surcharge. Huh? HEC is applied on the combined amount of tax and surcharge. Can you give me this amount?
192650.
196.
192650.
Okay. 192650. 192650, students. And from this amount, students, you'll reduce your TDS, which the buyer would have deducted. And after reducing the TDS, then the balance primarily will be the amount which is payable by him. Okay, which he will pay through self-assessment tax. So this is the format. How much is that? Yeah, Radha, you were saying something?
Sir, like basic, that unabsorbed basic exemption is not for the unindexed amount? Only in the case of index we are taking?
No, both. See, if you see in my see the calculation. Again, I'm coming back.
That's why I was thinking that why only 76.
No, have a look here. Your long-term capital gains unindexed was how much? 72 lakhs 98,000. Isn't it? And I reduced from that this unabsorbed base emission limit of 50,000. Isn't it? So
Okay.
I have reduced this 50,000 from that unabsorbed base emission limit, which is obviously your total is how much? 350 normal income. Base emission limit is 4 lakhs. So how much is unabsorbed? 50,000. So that long-term capital gains unindexed of 7298. From that I have reduced 50,000. And after that only we got how much? 72,48,000.
Correct.
And of that 12.5%, which is still very higher. So I will not take up this option while I calculate my tax liability. I will go with the option which is available to me of the indexed particular part. Got it?
Yes, sir. But okay, but GTI is being taken as 76,48,000. So I was like, where I am mistaking?
No, 70. This is 72 lakhs. So 72 lakhs plus 72 lakhs 98,000.
Yes.
Plus 3,50,000. There is other sources income also, no?
Okay, sir. Yes.
So this is 72 plus 350 comes to 76.
Okay.
Okay,
Yes.
and then therefore I say in 76, 350 is your normal income. So how much is the balance left? In this case, balance is 7298, which is for LTCG.
Yes.
Isn't it? And now normal will have 4 lakhs base emission limit. Of this unabsorbed is how much? 50,000.
50,000.
So 50,000 I'm reducing it from LTCG of 7298. So that gives me 7248.
Okay.
Because it is in 70s, I know. In fact, may I say to you, Radha, I also got confused on this particular part only. The numbers are very resembling, isn't it? 72 and 76. I also got confused in this thing, to be very honest, in this context.
One more thing which wasn't clear with regards to before 2001, you are saying that FMV or SDV comparison is being done, and whichever is lowest, we are taking that.
Yeah.
Then eventually on the date of transfer, we are taking whichever if it is crossing 1.0, then Why we are doing this much complications? I mean, like,
This actually got the rule came up. This one, this is just again, this is a challenge problem. I told you, na, if you see, Radha, remember my discussion which I was having with you when we were doing slum sale. The
yes.
entire game is that to reduce the, from the government point of view, if you see, na, they are trying to reduce as much as possible the cost.
Okay. Yes. Yes. Yes.
Isn't it?
Okay.
That is the reason why when it comes to cost, they are trying to reduce. Okay, what if the SDV is lower as compared to the FMV? So let's take up the SDV. That is
Yes.
the kind of a scenario which has been there. So this, they are trying to reduce the cost wherever it is possible, as much as possible.
But it's
And
just
when it
before
comes to
2001,
FVC,
right?
when it comes to FVC, taking the highest,
Highest of sale.
isn't it? So
Yes.
that is the overall scheme that you should understand. And this is same thing. We have proved it also when we were doing slump sale, that when it comes to the net worth reduction, it is only the book value WDV, which is getting reduced. And when it comes to that FVC, we take up the fair market value, stamp duty value, all that thing is considered.
Yes,
Isn't
sir.
it?
So that means before 2001 only this much is being done, or after that also we are doing the same?
No, before.
Only before, right? Or as
Only
of the
before.
2001?
Otherwise, they are normal cost. True.
Oh, normal cost only. Okay, sir. Thank you.
So let's proceed, students. So this is what it is, students. This was the biggest one, and this question, students, finally resolves your all the small question which comes after this. You may try, please do it for practice purpose. The other small question, all the concept is already being considered here because the subsequent question, students, you will get what? The subsequent question, small questions are there, forfeited and all. We discussed already in that context. So what will happen for forfeiture? So in this case, tell me one thing, students. This option of indexation, is it available to a partnership firm or only to resident individual and resident HUF? Only to resident individual and resident HUF. If supposing you are a company, if you are a partnership firm or say cooperative society, then any particular immovable property that may have been acquired before 2024, the July 2024, then in that case, the indexation option is not available to them. It is available only to the resident individual and resident HUF. Is that clear to all of you students? So this is one small particular point just to test you whether for a partnership firm, whether that option is it available to them for indexation, and the answer is no. Forfeiture, students, we have discussed elaborately. Just for you may not even solve it, you can just go through it. In fact, I will request to you to solve the same question which we discussed, because see, in this other one thing, unexhausted basic income limit also we have discussed in this question only. So this question is a master question, students, which take into account all the elements which we are required to be considered in this regard. All the elements which we are required to consider in this regard. I hope that all of you are clear with this one, students. Perfect. Students, just tell me, did you got this one? Your today's notes in the portal?
So 22nd August is the last date of the
Okay,
notes
okay.
of.
Maybe I think because it was a holiday yesterday, so possible. Anyway, students, now the IFOS students, now the head IFOS students, the residual head. Whenever you will do it in the same particular pattern, students, over here. Whenever students, you will do it in the same particular pattern. Which pattern? Entire IFOS students divided into three parts. Part number one is the gift tax. Part number two is the deemed dividend, and part number three is the miscellaneous. This is precisely how you can negotiate and trade off beautifully. Now, again, I'm repeating this part, students. Two things I'm deliberately keeping out, which I'm going to do once I do taxation of taxation of various entities, that chapter. At that point of time, I'm going to take you through two things. One is in the case of partnership firm, there is one important provision for capital gains. So when we do the taxation of the partnership assessment, at that point of time, we will link it up with the case for a very comprehensive question, the way you are going to get it in the examination, we'll be doing that particular concept in the taxation of partnership firm. There is one capital gains implication, students, that is there, which I have not considered deliberately. And second one, students, is a insurance policy maturity taxation. The insurance policy taxation, primarily the ULIP, the insurance policy taxation, students, this second concept also I'm going to take across in those particular segment only. So two segment I've deliberately carved out, which will be considered separately. And you will also, better for all of you, the way we have gone with the entire flow, with the theme, like the capital gains was divided, like in the case of charging section, the basic concept in the charging section, and then thereafter the business restructuring in this context, isn't it? All those case of business restructuring was being done. In that case, you will majorly find the question in the examination from the business restructuring. And please, again, I'm repeating, students, buyback would be the most important for your examination, because the scheme of buyback has completely changed. Earlier, the buyback taxation, students, was taxed under the head IFOS. Now it is getting charged under the head capital gains. And how it is charged? Now we have got additional tax liability also for the promoters and all. So the very good part is that since these lectures are there in the YouTube and all, which you can always repeat it, primarily just ensure to, if you get stuck somewhere, please ensure to go through that particular relevant video as well. Okay, but do ensure to go through it, because this would be one of the most important as far as the examination is concerned. And also along with that, demerger and slum sales. For the real estate and all the exemption of 54 series, students, you will not find independent question. Generally, they don't ask independent questions. Generally, what they do is that they merge it in the total income question. In the total income question, the way we have discussed the last question. So obviously, the last question was so comprehensive. What they will do? They will pick up 2 or 3 adjustment of that, and they will put it in the total income question. That is the general trend. And this is what you will find. But a standalone question, students, if you will find it, you will find it from the restructuring. You may get from demerger, you may get from slum sale, you may get for buyback, which is the most important particular area of the entire exercise. For your examination point of view only, in this context, I'm telling you. So coming to the IFO, students, I have told you 3 parts, divided into 3 parts. Which are the 3 parts, students? Gift tax. The second one, students, deemed dividend. The beauty of first and second is that, students, we have already covered, and therefore it will go very fast, except for one deemed dividend of 222E. Apart from that, you will find the things goes now very quick, and the remaining in one go. This is a flow. Again, students, in the remaining part, insurance amount which is received on maturity of insurance. This I am not going to discuss it primarily in the notes. I will keep a particular separate segment for it, because there is a capital gains implication, there is an IFOS implication. So we will not deal with it separately, only under one head. We'll deal with it, students, when we discuss certain things, because in GTI also, students, there are something on insurance taxation which is going to come. Chapter 8 deduction. So what happens is that the way, students, you remember PGBP, we did all the employee provisions together. Remember that technique? All the employee provisions together we did at one place. So it becomes then easier to comprehend. Same is also with this insurance particular part. It comes at different places. And that creates a problem for the students when they have to then finally revise. So the point which I am dealing with it is when you are going to revise, how you're going to revise it. And that is the reason why we are segmenting or fragmenting the topic in a logical way, so that you also revise in the same particular logical way, students, and that will make your revision very much plausible. So I'll come to gift tax first, and then I'll come to the deemed dividend part. Let's come to the gift tax part. Gift tax, students, will become very fast, because something, many things we did in capital gains, and something new, few here and there provisions are there, that we will finish it off from this discussion itself, this segment number 2. Can you see that? Students, peacefully, I'll give you 2 minutes time, peacefully. Read up till here. All the page numbering, students, you will find it over here itself. Fine, students? Read it, just let me know.
Yes, sir. Completed.
Completed? Perfect. So students, as you know, there are three categories which has been identified. One is already we know, popularly known as gift of money. So in excess of 50,000. Tell me a simple, in interest here, this question was very popular for all of you. If I receive the gift from a non-relative of 50,001, how much would be taxable? Only 1 rupee or entire 50,000 1 rupee? If I
Sir,
receive
in general, entire 50,000 1 rupee.
entire 50,000 1 rupee, students. There is a habit of people who keep giving extra 1 rupee as a good luck amount, isn't it? So when you have to gift somebody a money and maybe in check also, and you are intending to give 50,000 rupee, please don't put that good luck amount of 1 rupee. Because then what happens in the hands of the recipient? He will not be happy finding this gift of 50,001 if he is your not a relative. If he is a relative, then we know that gift tax is not applicable. But then in that case, entire 50,001 rupee would be taxable in the hands of the recipient who is receiving the amount. The other two students are relating to the properties in this case. Now, just first, before we proceed further, students, important is that this property definition is important in this case because the list which has been given to us so far as the property is concerned, this list is an exhaustive one. And what exactly you find it in this property definition? Property means the following capital asset of the SSE. And what is that, students? Immovable property, being land or building or both. Shares and securities, jewelry, archaeological collections, drawing, painting, sculpture, any work of art, bullion, and virtual digital asset. So you can see all the high value assets are only considered for the purpose of gift tax. So tell me one thing, students. Supposingly, I am getting a motor car as a gift. Supposingly, I am getting a motor car as a gift from a non-relative, and the amount, the value of that particular motor car is more than rupees 50,000. So whether this gift tax provision, will that be applicable in my hands? And the answer is no. Whether this transferor, for him, whether this capital gains implication, will it arise? Again, for him, the answer is no. Why? Because motor car is, if it is what, students? If it is a stock in trade, capital gains will not come. At the most, what will happen? PGBP will come, but capital gains will not come. Okay, PGBP will come because he's selling his stock in trade for free. Okay, please understand, students, a stock in trade which is sold for free of cost, will the chargeability will still be attracted? And the answer is yes in this context. In that situation, in the case of PGBP, students, the chargeability will still be attracted. He just can't escape from the chargeability under the head PGBP. Okay, but for the capital gains, it has to be a capital asset. Only then the capital gains provision is applicable. Only then the capital gains provision is applicable. Fine. Now tell me, students, supposingly immovable property. Please be careful. Huh? Immovable property, I'm giving you of two particular case. Two particular case, students, I'm giving you. One immovable property for the transferor I'm talking, not transferor, it is an investment in one case, and in second case, students, it is a stock in trade. Okay, so if you are a transferor in that context, if you're a transferor, students, investment, then it will go under which? For transfer, it will go under that capital gains. We all know. And the stamp duty value is what has to be taken, which will be compared with 110% of the consideration amount. If it is a stock and trade, students, it goes under that PGBP. And in PGBP also, students, the stamp duty value will be compared with the 110% of that particular for consideration amount. So that comparison is there in PGBP also. The one who is in the real estate one who is in the real estate business, for him also, the income would be under the PGBP, but for him also, the same particular provision is applicable, students. Which provision? Whenever he transfers the real estate, even as a stock in trade, for the transferor, we are talking about a transferor, the stock in trade, students, if they selling, PGBP will be applicable. Okay. Now comes to the transferee students. Now, very important students in this case. I think it is given over here. It is given, but let me give you this. So I have given you the transfer's point of view. Now, for the transferee who is receiving it, for the transferee students, who is receiving it? Receiving it as what? As a capital asset only he is receiving it. Transferee, he receives. Receives as what? He receives as a capital asset. Then students, IFOS, this section 92 will be applicable. 92 provision that we are learning right now. But what if the transferee receives this particular immovable property as a stock in trade then? Then student, this particular section 92M will not be applicable. If he is receiving as a stock in trade, 92 will not be applicable. This is one of the conditions, students, for the transferee, that the asset or the property that he is receiving should be received as a capital asset. If he is receiving as a stock in trade, it will not be subject to charge under the head IFOS. It will not be subject to the charge under the head IFOS. This point I'll show you in the notes only, but I just thought to first make a comparison between a transferor who's transferring as a capital asset, what is the implication? Or as against a transferor who's transferring the asset as a stock in trade, then what is the implication? In both the cases, the transferor will be subject to the charge, one in the head capital gains, another in the head PGBP. But when it comes to the transferee, for the transferee means the receiver. Receiver, if he is receiving that property as his capital asset, only then the chargeability would be attracted. If he is receiving that as a stock in trade, the chargeability will not be attracted. And that exactly is the point, students. So if you see over here, first of all, the list of the asset which we have just discussed about, which are the list? In the list, it is immovable property, land, building, or both. For movable property, you have the securities, shares, the jewelry, bullion, work of art, painting, and one more important addition, which is that, students, virtual digital asset, BDA. There is a separate topic, students, on a digital taxation in your module that will get covered separately. Okay, that will get covered separately, but still, for the context of I am receiving any bitcoins, a virtual digital asset I am receiving, students, and that I have received it without adequate consideration or without consideration, and the threshold of 50,000 is breached, is crossed. In that particular case, the receiver who is receiving this virtual digital asset in his hand, the amount will be chargeable under the head IFOS. The amount will be chargeable under the head IFOS. So just in that context, I'm just telling you. See here, the asset must be a capital asset in the hands of the recipient. In the hands of the recipient, students. I told you already. If it is received as a stock in trade, students, in that context, in the hands of the recipient, students, it will not be taxable. Even if in the hands of the transferor who is transferring as a stock in trade, it may be taxable under the head PGBP. But for the recipient, if he is receiving it as a capital asset, as a stock in trade, it will not be chargeable under the head IFOS. Fine, students. Rest of it, students, you will find all familiarity. Rest everything, students, you will find familiarity. Now, immovable property, students. Immovable property, what we do? What we do, students, in this case? We will first do the comparison. Comparison of what, students? Here, whether we should consider stamp duty value or we should consider the full value of consideration. We have to consider both, students. And as you know, if the stamp duty value exceed the 110% of the consideration amount, then stamp duty value would be considered. And if the difference between the two, be careful now, students, because I am the buyer, na? So supposing, students, I am the buyer, I have paid a consideration of say rupees 10 lakh rupees. Okay, the stamp duty valuation of that particular property happened to be 15 lakh rupees. So what will happen, students, in that context? The stamp duty valuation happened to be how much? 15 lakh, 15. How much I have paid as a buyer? 10 lakhs. The transferor was chargeable under the head capital gains on 15 lakhs. What about the buyer? for the buyer, they will say that, look, you have paid less. This is an inadequate consideration. Why? You will first consider 110% of the consideration amount. 10 lakhs plus 110% is how much? 11 lakhs. Whereas the stamp duty value is how much? 15 lakhs. So it means stamp duty value is still higher. So what is the difference now, students? Difference is the consideration amount and the stamp duty value. The difference is rupees 5 lakhs. So is the difference more than rupees 50,000? Is the difference more than rupees 50,000? Answer is yes. So what will happen? The entire difference amount of rupees 5 lakhs will be chargeable in the hands of the buyer under the head IFOS. The entire difference amount of rupees 5 lakhs. What is 5 lakhs? 15 minus 10. That difference of 5 lakhs. Is it more than 50,000? Yes. So because it is more than 50,000, because the difference amount is more than rupees 50,000, entire difference amount will be charged under the head IFOS in the hands of whom? In the hands of the buyer. Is that point clear to all of you students? Please let me know first. Then only I'll proceed further. Quickly, students. Clear with this one?
Yes, sir. I was asking that specifically IFOS has the property definition. So any asset other not falling under that property wouldn't be taxable, no matter what.
Any other property other than what has been listed here will not
Correct.
be taxable. It will be considered as a capital receipt, not taxable. So
Okay.
if supposedly the chargeability has to be attracted, rather it has to be attracted in one of the 5 heads. This happened to be your last head, IFOS. Obviously, for the recipient, for IFOS, we are dealing for the recipient. So if I'm receiving any other property other than these specified property, IFOS happens to be my last head. It definitely cannot fall in that first 4 heads. Therefore, I am coming to the head IFOS. So if it is relating to any other property I have received other than the specified list, then the other property cannot be chargeable under the head IFOS. And if it cannot be chargeable under the head IFOS, it cannot be chargeable anywhere.
Yes, sir. That's why, specifically, the movable property share securities has been listed. Any other movable property, as you said, motor car wasn't taxable.
Not taxable. Perfect.
Okay,
Fine.
sir.
So
But if it is
only,
under, yeah,
yeah,
yes, sir.
please say.
But if it is going under PGBP for profession, then only it is being taxed. Else, it is not being taxed.
Yeah, very good. That's
Okay, sir.
perfectly point. With profession, you now remember very good interlinking, brother. Appreciate
Yes.
that. Very good
Okay, sir.
interlinking. That you have done for profession, benefit of business, benefit from profession received. Remember that we all discussed the
Yes,
charging
section
section.
26 2K.
Exactly. Very good. Excellent. Good show. So this is where the chargeability probably would be attracted there. So yes, you have to see this, but yeah, there is a one clause under that PGBP. So if I'm receiving this in the course of my business or my profession, like motor car, I would have received. And if it is a benefit of business or a benefit of profession, specifically charged under the head PGBP. Very good. Excellent. That's a good catch. The stamp duty value, students, obviously now, as I told you, students, over here, the comparison you people have to do. Consideration amount has to be compared with the stamp duty value for immovable property that you have received. Now, with stamp duty value, there are 2 stamp duty value. Either you take the date of agreement or date of registration. Same concept, students, that we discussed in the head capital gains. We prefer general provision is date of registration. But we will take date of agreement if any consideration that you have received on or before the date of agreement. First of all, you have to receive some consideration amount. And whatever consideration amount that you have received on or before the date of agreement, that consideration amount should be in the specified mode only. So if you have received the consideration amount and that any consideration amount, that should be received. And second point is that consideration should have been received on or before the date of the agreement in the specified mode. Which are the specified mode? We already have seen it. This is again the specified mode. Specified banking or online mode. So if you receive through this mode, in that case, then the stamp duty value will be as on the date of the agreement. That will be considered for the purpose of comparison with the actual consideration. and it will not be the date of registration. Clear, students, in this case? The same thing, na? So it's a repetitive part. So this is simply a repetitive part of the capital gains, and that is the point. Now, students, under which cases the gift tax is not applicable? Please have a look, students, over here. This point I discussed with you. I just wanted to see whether you people recall it or not. Gift tax, huh? Gift tax, whether gift is of money or gift is of the specified movable property or the gift is of the land or building, whether the gift is without consideration or for inadequate consideration and the inadequacy is more than rupees 50,000. So that gift tax provision under section 92 will not be applicable in this following cases. Which following cases? If the gift is received in this particular manner. Just read this one out, students, and tell me what is that we discussed when we were discussing under the head capital gains. Very carefully read it, students. Ready, students?
Yes, sir.
So initial
Yes, sir.
yeah. So initial particular point, students, I think in literacy also you people would have referred it. Relative, perfectly fine. On occasion of marriage of the individual, students, only marriage, huh? Not engagements, birthdays, and all. That is not there. So that is the only occasion. Under a will or by way of inheritance, this also gets covered in section 70. To that extent, may I say that way? In contemplation of death of the payer or the donor. Okay. So maybe, even though there may not be any will, but say, for example, he is having a terminal disease, and in that contemplation, if he's transferring it, even that is covered. From any local authority, that is a quite specific thing. Just keep moving further. Students, this part is a trust part. This right now, na, just read it. Let me see how many of you can retain it. I will not discuss this particular part. This part in trust taxation, this part I'll just try to pull it up. And at that point of time, let me ask and let me see how many of you can recall this. You'll say so, but we have not learned it, means we have not get any explanation. That explanation I'll do there, but just I will tease you that time. and wanted to very would be keen to know how many of you remember this. Okay. The next bullet point, students, is what we discuss in the head, capital gains. All these clauses, students, do you see that clauses, amalgamation, demergers and all? In the course of the amalgamations, if I'm receiving the assets, if I'm receiving the shares, then yes, there is no capital gains implication. But then somebody can say, but you receive the shares without consideration. Then in that particular context, gift tax is applicable. So whether gift tax, will it be applicable? And the answer is no. This is the entire list. You can refer it from the capital gains. Now, students, today's assignment, kindly tick mark those lists in the head capital gains and do make a mention that these were being covered under the head IFOS, where the recipient will not be charged to any gift tax. The recipient will not be charged to any gift tax. This, students, is going to go a long way, not only for your examination. For examinations also, I have told you one question, students, when we were doing demerger, in that point of time, I have told you that time, maybe I have also given a note that if the question talks about what is the tax implication in the hands of the recipient, at that point of time, I was telling you that recipient, section 70, primarily through section 70, he gets a shelter of capital gains, okay, for his transfer, for which he has received something. And what he has received something, even that is protected under the head IFOS by virtue of the 92.3, which means that this, what he received on account of his transfer, that receipt is not subject to any gift tax. No gift tax, students. Okay. Next point, students, is also about the trust particular part. So this also would get covered in the context of trust. Generally, it is for the private trust. Generally, it is a private trust. Now, students, this rule 58, you can just read it as a homework or you can just read it for knowledge purpose. This particular part. If at all you have to remember, students, you just only have to remember up till here. Okay, rule 58, I've given it, the content of it, you can just read it in the rules itself, here which has been given in the notes, whenever you get some time. Just read it for knowledge sake. Once, students, we will not be harping on this particular part. So that is one thing which has been there. But at least you need to remember the remaining bullet point, students. Okay, because if the examination, they have to take one level up, they will not only be targeting from the transferor point of view, but what happens in the hands of the transferee. That way. Who is relative, students? Again, this definition, I'm leaving it to you. Relative is this definition, students. So you should know that if you are gifting to these people, they're in their hands, being the recipient, it is not taxable. So who should be the recipient? Recipient should be either the spouse, brother or sister of the spouse. This is the entire particular list, students. Okay. Again, I'm not deliberating on the same. This is something people would have read it earlier also. Read it again. Primarily, again for knowledge sake, primarily, they will not be very peculiar to target this sort of a question. This doesn't happen in final C. There are many things to be targeted. So they don't target it, but yes, you should know the list. Coming further, students, after rule 58, coming further. The transaction seen from both the sides. We have been discussing this, students, right from capital gains, and I told you, therefore, virtually I have completed the IFOS side also, where the transaction is seen from both the sides. Just now also I explained to you for the assets, isn't it? So let's formally complete this particular part from this particular thing. So from both the sides, you should be careful to see this transaction, one from the point of view of the transferor and another point from the point of view of the transferee. So what has to be seen from the angle of the transferor? Land or building held as a stock in trade by the transferor. Students, held as stock in trade for the for the uh, for the transferor, it is a business income, PGBP, isn't it? Section 53, to be very precise, is what will be applicable. Capital gain starts from 67, IFOS 92. So therefore, in this context, 53 is the PGBP section. You don't remember the section number, it is still fine. Where the stamp duty value exceed 110% of the consideration, the stamp duty value is taken as the full value of consideration, and the difference over the cost is the business income. But that difference in this case, so that is a difference which is a business income, PGBP. And what about for the recipient? For the recipient students, it will be considered as what? As gift tax only if that particular land or building is received as a capital asset. It is possible, isn't it? It is possible that for the seller it is a stock in trade, for the recipient it is a capital asset. Obviously, he is a dealer in the real estate, and I am not having such business. So when I receive this particular real estate from this dealer, for me it is like a capital asset. And if supposingly I have paid the consideration which is less than the stamp duty value, same example, students, stamp duty value is 15 lakhs, and my amount which I have paid is how much? 10 lakhs. And for me it is a capital asset. So the difference, first I have taken 110%. First I have taken 110% of the consideration amount. It is 11 lakhs. Is my stamp duty value still higher than 110%? Yes. It means that I now have to suffer gift tax. Why? Because my stamp duty value is still higher as compared to 110% of my full value of consideration, of my consideration paid. So what is the difference in this case? Difference is 5 lakhs. Is the difference of 5 lakhs more than rupees 50,000? Is the difference of 5 lakhs more than rupees 50,000? Again, the answer is yes. So whether the entire difference of 5 lakhs will be taxable? Answer is yes. So therefore, that is the point, students, over here in this context. So students, over in this regard, this is what it is. So if this is for the land or building held as stock in trade, what about the land or building held as capital asset? Same thing. Only thing that changes is the section. Under the head capital gains, it will go in the hands of the transferor. And for the transferee, the position is same as above. For the transferee, take it from me, students, transferee has to receive that asset as a capital asset. Only then IFOs will apply. Date of agreement other than registration, that will be applicable. We can take date of agreement for the purpose of stamp duty value, provided that condition of banking and online payment is satisfied. Cost of acquisition for the recipient. Now, obviously, transferor, we will not see anything because he has already transferred, so it's not applicable. For the recipient, what is the cost? So, recipient students, please be careful. Recipient, if an amount has been taxed, say for example, students, just take across the same example. My original example, students. My original example. What is the cost over here? And logically, you have to tell me, students. Don't by heart. Tell me logically, and that will be your provision only. Logically, if you tell me, that will be a provision only. Same example. So, real estate purchased for 10 lakhs. Okay. Stamp duty value was how much? 15 lakhs. Already concluded students. What has happened in that case? 92. Gift tax. IFOS. How much is the amount? 5 lakhs will be taxable. Okay. So question to all of you is, what are the question, students, in this case? Question is, cost in the hands of purchaser. Cost in the hands of purchaser.
₹15 lakhs.
And how you got the 15 lakhs?
Sir, because under IFOS also we had paid tax upon 5 lakhs. That's why we
So
are
10 lakhs
considering.
what I have paid plus 5 lakhs is already being taxed. Therefore, 10 lakhs what I have gone from my pocket plus 5 lakhs already has been taxed. So what is the cost? 15 lakhs. And in the law, they have written stamp duty value. So stamp duty value is what is given as in the law. So cost in the hands of the purchaser, students, cost in the hands of purchaser, students. In the law, they have written what they've written in this context. In the law, students, they have written in the section they've written as stamp duty value. So many students start getting confused, sir. What is this stamp duty value? Then they think we have to by heart it. You don't have to by heart it. You have derived it already. 15 lakhs. 10 lakhs is what you paid. 5 lakhs is the amount on which you have paid the tax. You have paid the tax under the IFOS. If you take the cost as 10 lakhs, then what happens? There will be a double taxation. Because to the extent of 5 lakhs, again will be taxed when you subsequently sell that asset. If you take the cost as 10, Your capital gains would get increased by 5 lakhs more than. So therefore, there would again be a risk of the double taxation to the extent of rupees 5 lakhs. And that is the reason why, students, the cost in the hands of the purchaser happens to be stamp duty value. Is that point clear to all of you, students? Kanaya?
Yes, sir.
Yogendra?
Yes, sir.
Perfect. So just keep this perception in mind, because these concepts, students, when you go further down in the advanced topics, this concept only will help you to survive. Okay. Uh, Withholding tax, so tedious part I'm not touching upon right now, but for the buyer, just for the buyer, there would be some implication of TDS. For the buyer, there would be some implication of TDS. What is the implication of TDS? I'm deliberately not touching that. That is anyway is covered separately in the TDS chapter, but notes it has been given so as to make a comprehensive revision. So as to make a comprehensive revision, students. So students, that is primarily all which has been there so far as the gift tax is concerned. Let's do some couple of questions over here, students, in this case. Now, on bonus share, students, there is one case law which has been there in this context. Issue of bonus shares, if you see how the bonus has been issued, students, if you know for the company issuing the bonus shares, it is just nothing but the capitalization of your reserves. It is nothing but the capitalization of reserves, isn't it? What happens is that reserves account debit to share capital. That is the general entry that we pass. When the bonus shares are issued, reserves account debit to share capital. So therefore, they have written here, the issue of bonus shares by capitalization of reserves is a mere. So what is capitalization of reserve? This is what it means. What is capitalization of reserve, students? Reserves account debit to bonus shares to share capital. That is the capitalization of reserves. Is merely reallocation of company's fund. There is no inflow of fresh funds and no increase in capital employed. And the value of the original shares fall correspondingly. Obviously, when they issue the bonus shares, the per unit cost or the value of the original will fall correspondingly. So that the market value and the intrinsic value of the original and bonus shares taken together remains much the same as the value of the original shares before the issue. That is same thing, isn't it? Any profit derived by the shareholder on receipt of bonus shares is thus adjusted by the depreciation in the value of the shares originally held. Because I was holding primarily one or the original shares of Reliance. Obviously, the intrinsic value of that original shares also includes the reserves of the company. Now that reserves has not been given as bonus shares to me. So if I do this, it's like a splitting my original value of the original shares. It's just like a split of the value in the value of the original shares, because the value of the original shares of the company includes also the reserves of the company, because that reserves goes to the shareholder. And therefore, when the bonus shares are issued, in that case, the reserves are now being capitalized. The reserves are nothing but capitalized. So what happens? My overall value of all the shares held after the bonus remain the same as compared to what? As compared to the value of that original shares which existed before the bonus. So technically speaking, I have not received like a gift. It belonged to me earlier also. It belonged to me now as well. So there is no such gift which I have received in this case. And because there is no gift which I have received in this case, therefore gift tax is not applicable. I hope that all of you have understood this concept which we have discussed just now. Please let me know, students.
Yes, sir. But need a clarification on depreciation of the value of the shares.
See?
So, what is the depreciation in value
Depreciation
of the
means
share?
after bonus, what happens? The original shares will have a split value. Like original shares, supposing the intrinsic value of the original shares before the bonus issue was, say, 120. That intrinsic value, how you got 120? That value also included the profit and the reserves also of the of that particular company, because that profit also belonged to me,
Yes, sir.
isn't it? So therefore it is 120. So now what happens in that 120? There is already the reserve which is taken into account. Now, if I get the bonus from that reserves, so what happens? The intrinsic value of the original shares will reduce to the extent of the value of the bonus shares. So if the value of the bonus share is say rupees 40, I'm just in the overall value, market value in this context. So therefore, now what happens? My original shares value is 80 and the bonus is 40. So the total is 140 technically in that same way. So, in the real sense, when the shareholder is receiving a bonus shares, he is not as such receiving anything, technically speaking. What belonged to me as a shareholder of the company is now the same thing. But the only thing is that earlier, what belonged to me was represented as a reserves. Now it is being represented as bonus shares.
Just the form is changing.
Yeah, that is only the form has changed. Perfect, Yogendra.
Yes.
Okay, so that is the thing. That is the reason why gift tax is not applicable when you receive the bonus shares. That is the point. So let's see illustration number 6. Mr. A dealer in shares, received the following without consideration. So please understand, friends, he's a dealer in shares. And if he receives the shares, then that shares he is receiving as a stock in trade. Supposingly, if he is receiving a shares as a gift, that will be received by him as a stock in trade. And if it is received as a stock in trade, we already have seen it is not chargeable under the head IFOS. Okay. So Mr. A dealer in shares, received the following without consideration during the tax year 26-27 from his friend Mr. B. Cash gift of 75,000 on his anniversary on 15th of April 2026. Bullion on his anniversary, students, will it be taxable? Yes, fully taxable. Bullion of fair market value of 60,000 on his birthday on 19th of June 2026. See, if he is receiving from his relative, then for relative, we don't see the occasion. For relative students, we will not see the occasion, whether it is marriage or anniversary or birthday. If you are receiving it from the relative, it is not taxable at all. But from a non-relative, it is only one occasion that you receive from the non-relative, that it will not be taxable, and that is marriage. That is it. So bullion of fair market value of 60,000 on his birthday on 19th of June 2026, and a plot of land at Faridabad on 1st of July 2026. The stamp value of which was rupees 5 lakhs on that date. Okay, so he has received, students, without consideration. So obviously that stamp duty value in entirety is more than rupees 50,000, and therefore the entire stamp duty value will be taxable in the hands of Mr. A. Mr. B had purchased the land in April 2009. In April 2009. Okay. Mr. A purchased 1,000 shares of X Limited at rupees 400 each on 19th June 2026 from his friend Mr. C, also a dealer in shares. The fair market value being 600 on that date. He sold these shares in the course of his business on 23rd of June. What we will say, students, it will not be taxable. Why? It is not taxable under the head IFOS. What is the reason? Reason we all know, because it is received as a stock in trade. It is received as a stock in trade. And accordingly, the cost would be 400. When you will calculate the PGBP, you will take the cost as 400. Why not 600? You will not take 600 because 600 would have been taken if the difference between 400 and 600 would have been taxable. The difference, which is 200, if that difference of rupees 200 would have been taxable in the hands of Mr. A, then we would have taken the cost as rupees 600. But the fact that the difference was not taxable, therefore, in this case, 400 rupees that he has paid is what will be his cost. 400 rupees that he has paid is what will be his cost. Fine. On 1st of November 2026, Mr. A took possession of a building booked by him 2 years earlier at rupees 20 lakhs. Students, On 1st of November 2026, Mr. A took possession of a building booked by him 2 years earlier at rupees 20 lakhs. The stamp duty value on 1st November 2026 was rupees 32 lakhs. And on the date of booking was 23 lakhs. He paid rupees 1 lakh by account pay check as down payment on the date of booking. Tell me, students, which stamp duty value will then be considered? Date of agreement or the date of this thing?
Date of agreement.
Date of agreement, students, isn't it? And since, please understand, students, he is taking the possession. Huh? So he is taking the possession. Fine. So the fact that he is taking the possession, students. But they have said about the booking. Okay, yeah. Date of booking will take 23 lakhs. So students, what we have said about the immovable property, students, possession is a transfer in the hands of whom? In the hands of the transferor. We already discussed that. Possession is a transfer in the hands of the transferor. So transfer will exit and the recipient will enter. Remember that lecture? I told you the interplay. He will exit and he will enter. It cannot happen that on the same asset, primarily in this context, both of them are charged in the same head. It can never happen that way. Fine. So therefore, if one is making an exit, another will make an entry. This is what we have seen earlier in that lecture. 2 lectures before, we have discussed this interplay, exit and entry. I give you some more example also that time. So students, as you said it correctly, yes, perfect students, we will take as on the date of booking, 23 lakhs stamp duty value. And because he has paid that 1 lakh rupees on the booking date, which was paid as a down payment, and that was paid through account pay check. On 1st of March 2027, he sold the plot of land at Faridabad for rupees 7 lakhs. Okay, so now here, and you have to calculate the capital gains also, students. 2 heads of income are covered. One is IFOs, another is capital gains. Now you are graduating to the total income, students. See how little bit is coming, both the heads together. So what he has, understand here. Please be careful, students, over here. One is about the shares. Students, one is about the shares, which has been there, which has got both IFOs and capital gains, both. One is about the shares. Sorry, IFOs will not be there, only the capital gains will be there. Sorry. Here there is a capital gains. And one which he got in Faridabad, stamp duty value which you have taken as 5 lakhs, even this will enter into the head capital gains now, calculation of capital gains. Fine. So first, students, in this particular context, let's have a look. If you want to make a statement over here, let's see the statement. Students, have a look. First, IFO statement. Let's have a look to our IFO statement. 75,000. These are the cash gift. Then bullion, which was received, and the aggregate fair market value was more than 50,000. So 60,000 is what you take. Stamp duty value, this is also without consideration. Stamp duty value, which these are the things that he received from Mr. B. From Mr. B, he has received it. 5 lakhs, therefore, will be the value of the land that will be charged in his hand under the head IFOs. Tell me one thing, students. If the same Faridabad land that he received in the current tax year, it is sold in the current tax year. So tell me what will be the cost? Selling price, stamp duty valuation, I think you will say herein. He sold the plot of land for rupees 7 lakhs, Faridabad. Fine. Now the question therefore is to all of you. What will be the cost for him? The cost definitely would be what he's already been taxed in IFOS. The cost would be what he's already been taxed in IFOS. How much is taxed in IFOS for this Faridabad land? 5 lakhs. How much is taxed for the Faridabad land? 5 lakhs. Okay. So this will become the cost for him. This will become a cost for him. Let me ask you students one last question since we are over here. Will you do the clubbing of period of holding with the previous owner? Because when Mr. B has purchased, students, when Mr. B has purchased this particular land, they have given you that date also, 2009. So therefore, the question to all of you is, will you then do the clubbing of period of holding of B as well with period of holding of A, who is the assessee? Will you do that?
No, sir.
And why you say so, Yogendra?
Sir, we have charged that 5 lakhs rupees and
Exactly.
IFOS.
Very good.
If
Very
we
good.
not charge it, we will consider the
Very
PNW.
good. So if we would not have charged, which means that the transferor who has transferred Mr. B, if that would have been covered, where students in this context in section 70, then only we would have considered this, what Yugandhar said just now. But the fact that this was taxable already, so therefore, and now because it is taxable, do you go to the cost to the previous owner here? Do you take the cost to the previous owner? No. What is the cost for you? The cost would be what you have paid in this context. Sorry, the cost will be what you have been charged when you receive this particular asset. So that becomes the cost. So if you have been already being charged, so therefore the question of going backward to identify the cost or to identify the period of holding, that backward calculation, students, will not be required. If you were not being charged, then only the backward calculation would have been seen. But in this case, you would not go
So
backward.
already you were getting that as a capital asset, right? And that's why under the head of IFOs it was charged. But
Yeah.
since you said that POH should be of the capital asset, so as a capital asset you are being charged under IFOs. That's why you are taking that period of holding.
Exactly. Very true. That is also one of the way to look at it, Radha. One of the way to look at it, isn't it? So now come to point number 4. The chargeability has already been attracted as a capital asset. Perfect. Point number 4. Shares of X Limited purchased from C at rupees 2 lakhs below fair market value. But you purchased it, students, as a dealer. And that was as a stock in trade. And because it was a stock in trade, students, it will not be what? It will not be charged to you under the head IFOS. Okay? That is therefore nil. Last, students, is the building. You said, students, building, which stamp duty value? Just have a look. Which stamp duty value? Date of booking. Date of booking, students. Just a second. Date of booking. So, date of booking, students, here it is. ₹23 lakhs. Now, this will be compared with, students, with what? With that 20 lakhs. What I have paid. So that is first, in this case, before that, students, what we used to do? We used to always compare with 110%. Let's not forget that. So please first compare whether the 23 lakhs exceed 110% of the consideration that you paid. And the answer is yes. If you take 110%, it will become 22 lakhs. So yes, you will say that the stamp duty value exceed the 110% of the consideration paid, which means that the entire difference now would be considered. Entire difference of 3 lakhs will be considered. Now this 3 lakhs will be compared with the entire difference of 3 lakhs will be compared with 50,000. So does the difference exceed the threshold of 50,000 also? Again, the answer is yes. Again, the answer is yes. So therefore, in that particular case, we will say that the entire difference of 3 lakh rupees will be charged. Did you realize one thing, students? In the case of IFOS, there are two thresholds that is getting applicable. Did you realize in the explanation while we were explaining this? There are two thresholds which are getting applicable for an immovable property for in the hands of the recipient. One is that 110% threshold that needs to be crossed, which means that stamp duty value should be higher than the 110% of the consideration that you have paid. Only then the game is on. If the stamp duty value does not exceed 110% of the consideration amount paid, then IFO's chargeability will not be attracted. So first I need to cross this first threshold of 110%. Once I've crossed the threshold, then I will take the entire difference. And the entire difference in this case is 3 lakhs. And then this 3 lakhs will be compared with that 50,000 threshold, the basic threshold which is there under this particular IFO head. Because the gift tax is applicable only when the gift amount is more than rupees 50,000. So the entire 3 lakhs should be more than that threshold limit of 50,000, which is the case, and hence the entire 3 lakh is what is taxable under the head IFOS. So entire 3 lakhs is what has been taken over here. Fine, students. So that is exactly the point. So 3 lakhs is what has been taken, and this is what you get. Now, students, one question was that didn't he sold also the shares? Only the capital gains which you are computing is for the transfer of plot of land in Faridabad. What about the transfer of shares? Shares also he sold, no? What he receives at that 400 rupees per unit per share. Whereas the fair market value was 600. So the difference was at 200 per share. And he also sold in the same tax year, the entire share. There should be a short-term capital gain, isn't it? There is no calculation of that. Why?
Sir, he was a dealer in shares, so
Dealers
it
in
will be stock.
shares. And the question is only for calculating IFOs and capital gains. Deliberately, I have made you just written their CG part. The question, students, is read the question carefully. They are only asking about IFOs and CG. That is it. If they would have asked you total income, then what would have happened? In the same question, students, just modify the question, make this a total income question. Then what will happen? If it is a total income question, students, in that situation, you will say what? Then even the PGBP will come into picture. For the shares that he receives as a dealer, which is a stock and trade for him, then what he paid was 400 per share. Against that, what he has transferred, that difference into number of shares would be his business income. IFOs and capital gains, you already have it in front of you. I hope that all of you are clear with this one, students. Students, rest of the things, you may take this as a homework, which is good for your practice only, students. Everything is now very simple, actually. Will you want to take this as homework so that we can switch to dividend tax? It will be very easy.
Yes,
You
sir.
enjoy also. Okay? Radha, Kariya?
Yes, sir.
Yes, sir.
Or else let's do one question. 7 I give you as a homework. Let me do 8. 8 is Hari. And here it is both the ways. Let's do this both the ways, two sides, transfer and transferee. So at least that real estate transaction gets concluded once and for all. And then we move to the dividend particular part. So question number 7, students, at least do that. Chances of that being asked is less, but at least conceptual clarity would be there. Mr. Hari, a property dealer, sold a building held in the course of his business to his friend Mr. Rajesh, a dealer in automobile spare parts. Students, for Hari, it is a business income. 53. What about for Rajesh? Is he receiving this building as a stock and trade? No, he is a dealer in automobile spare part. So definitely for him, it is not a stock and trade. It's a
No, sir, it is a capital asset to Rajesh.
Yes, exactly, Yogendra. So therefore, what will happen? For Rajesh, it will go under the head IFOs. Very good. So therefore, this is what it is. And then when the stamp duty value was rupees 150 lakh, students. So that we will see the difference and all. The agreement was entered into 1st of September 2026 when the stamp duty value was 140 lakhs. We will take agreement value, but for that condition has to be satisfied. Mr. Hari had received a down payment of 15 lakhs by a cross check from Mr. Rajesh on the date of agreement. Students, tell me whether, with this much information only, you tell me, students, whether you will take, whether you will take this date of agreement or date of registration.
Date of
Date of
agreement.
agreement.
Why is it so?
So because it is
So the
cross check, right? So that individual means that it's account pay check, and that is online mode. So yes.
So this 150 lakhs, we assume it is a date of registration, sold. In this case, can you see this one, students? Now just have a look. Just have a look, students. We take what, students? 150 lakhs. 150 lakhs. You'll say, but sir, cross check, isn't it? You know the difference between a cross check and account pay check? You'll say, sir, this is where you have to read this question very carefully. This comes in PGBP also. Remember that disallowance in excess of 10,000 paid on a single day? Otherwise, then by way of account pay check or account pay draft or the specified online mode. There also they have written for a 10,000 limit per day, single day limit in PGBP when you make the payment of the expenditure. There also the per day limit is 10,000. And if you have to pay beyond that, then the amount has to be paid by account pay check or account pay draft or the specified online mode. Debit card, credit card, so on and so forth. You say, but what the difference? Do you know cross check looks like what? This is how it, students, when you do this and you write name of Mr. Rajesh and say 50 lakhs. This is an account pay check. But you say, sir, account pay means we should write account pay here. No, this is also an account pay. The name of the pay is written. Then in this account of pay, this is this thing that is there. If I take another example, if I just show you one more example over here, so therefore you be careful. So this is one of the general way of making the check. Many people make the check like that. That is an account pay check. This is also an account pay check where you put this and you write account pay. Doesn't matter. Even though you don't write the word account pay, you just cross two lines and then write the name of Rajesh. It is an account pay check. So this is also an account pay. Obviously, this goes without saying it's an account pay. So that is also an account pay. This is also an account pay. Do you know what is a cross check all about? So many of you would have thought, sir, the first example, we thought that it is a cross check. No, this is an account pay check. In the account of the pay, do you know what is there for the cross check? You should have known by now. The cross check, students, goes like this. The check shape looks like this. Cross 50 lakhs. That's it. Which means that the pay name is not written. This is a cross check. Do you know the implication of this amount? And the signature is there. It's not a without signature. The signature is there. It don't know what is the implication. It's just a money now. And this can keep passing on the hands now. Many transactions can take place in between. And the trail will be lost. And the last person who gets it, finally, he will write his name or anyone's name and then deposit in the account, and accordingly the amount will be credited. So what happens? The first person who issued the check and the last person who debited, finally he has written his name on the check. Only that transaction is what is reported. In between, through this check, where the cross is done without putting the name of the payee, in between, all the transaction that has happened goes unreported. And therefore, this is what is severely taken, students. And therefore, this is the default. So this is known as a cross check. This one is account pay. So cross check, is it allowed permissible mode? No. And you now know why it is not a permissible mode. So therefore, if you have received the amount through a cross check, then it does not satisfy those condition of that PGBP limit of 10,000 or the capital gains and IFOS, where we take up the stamp duty value on the date of agreement. For that, we require either the payment made through account pay check or account pay draft or the specified banking mode, online mode. So this does not satisfy that particular criteria, and hence we will take the date of registration. And what is the date of registration? 150 lakh students. Is that point clear to all of you students now?
But sir, the pay's name can be written now even though after receiving cross check. That though that payee himself
So
can write it.
generally, nobody does it. You know, these things are done in a very close particular cartel. This does not happens openly. These things happen like 5 or 6 people in the cartel. They will keep circulating this particular amount, and many transactions in between get lost. In this case, they cannot be reported. So this is what the government is targeting it. That if a cross check is given, and through that, if you are putting it, then the government knows the implication of the same, and hence they specifically make a reference of account paycheck. Okay,
No,
this
sir,
does not
I
happen
was
openly.
asking differently. Like, if you're getting that cross check, na, sir. So,
Hmm.
in that, the payee can write his amount, write his name and then get it encashed. Not a big
Yeah,
deal.
yeah, that is
So,
true. Very true.
this concept is academically valid then. That's what I was thinking
No,
about.
no, that is true. Academic in the sense, see, if I'm receiving it, it
Correct.
means I'm a person in that cartel, and I'm also intending now what I have received is a money in my hand. So I'm not going to
Yes.
use it for the purpose. I also don't want to report my transaction with other person. So what I'm going to do, I'm going to sell some property to him, and I'll say, or I'll buy some property from other party, and what I'll do, I'll give him this particular cross check which I have got. So that transaction is unreported in this context. And the person who would have bought this property from me, if he wants, and for which sorry, I received this particular, I had this cross check with me and I gave this particular thing to get the property. Now, the person who got this particular cross check again, he will also use the same cross check for some other transaction to buy something which he doesn't want to report it, say bullion only. In that context, he doesn't want to report it, he will give that particular cross check to the other person, and that other person also would have some transaction which doesn't want to report it. So this happens in a very close knit group. This doesn't happen openly, and this is the reason why the government wants to target this. Obviously, any person who receives unrelated party who is not a part of the cartel, he will write his name and
Correct.
he will bank it.
And that's how the cartel will get targeted by the
Yes,
government.
yes.
Got it, sir. Now I get it.
Okay, so that is exactly the point. So I think now students, manageable this particular question from both. For him, Hari, it will be PGBP, and for him, it will be this thing. Only this point I thought was worth to be considered because this cross check is where you people would have gone wrong. Rest of it, students, I think you will now manage. Fine, students.
Yes, sir.
So, students, you can take a break quickly and then we'll meet up 10 minutes break and then a dim dividend. Sanket ji, Sanket ji, 10 मिनट का ब्रेक ले लेते हैं. स्टार्ट हो गया शंकर जी? So now, students, we move to our another important point of IFOS, which is the case for the deemed dividend, particular part. So, students, in the context of deemed dividend, let me first share. In the context of deemed dividend, students, there are couple of sections which is very important for your examination point of view also. Although we will be doing all the clause, but couple of them are very important. One of which we already have discussed under the head capital gains, which is the liquidation in that context, and one which we are going to exclusively discuss in this particular head, apart from the remaining small other items. So bear it in mind, students, this is one of the most important area from examination point of view also. And there are some very important amendments which has happened, students, in the Finance Act 2026, applicable for tax year 26-27. What was the position in the last year and the position in the current year has got a significant change. Two important changes has happened. One change we already have seen on the buyback particular part. Students, buyback we have discussed in the capital gains. We have solved the practical questions also in buyback in the head capital gains. So that is one change that has happened earlier. Again, I'm repeating, students, this point. Again, I'm repeating this point. Students, can you see the slide now? Confirm once.
Yes, sir.
Perfect. Again, I'm repeating this point, students. Buyback till last year, till last tax year, 25-26, it was considered as a dividend income. So anyone who would want to know what was the position before, they can read this paragraph. I just deliberately don't want to read it out because this might create some sort of a this thing. I just want to be very clear to all of you that buyback now is targeted under the head capital gains as per the amendment that we have seen and the practical questions that we have seen. Earlier, buyback was charged in the hands of the shareholder under the head IFOS, and that is as a deemed dividend. That clause is out. Now we have exclusively buyback taxation only under the head capital gains. Other than that, students, see, this is section dividend 240. Earlier, old law, students, it was 222. In the new law, 240. At least you need to remember this section because this section, students, is an important one, the definition. Now, 240, if you see over here, various particular A, B, C, D, E. Okay. Earlier it was still F. F was for buyback. Now it is still E, 240E. So students, what I'm going to do would be this, that generally students see dividend taxability over here. We all know in this case, dividend, be careful, students. To income, I'll just try to target for all of you. Just take this one as a note, students. This is an important note. First, before we start off, and this was one question and one adjustment that was targeted in the May 2026 examination in your question number one. In your question number one, students. So under the head IFOS, section 92 is a charging section, students. Section 92 is a charging section for IFOS. Now, students, what 92 says, this part we are doing it right now, the dividend part, which this dividend includes deemed dividend. You will take a note of this one, students, all of you. This includes deemed dividend. Deemed dividend. Okay. So dividend includes deemed dividend. And just be careful, students, on one more particular point. Oh, just a sec, sorry. Dividend includes what I've written, deemed dividend, and second is the interest income. Now, students, interest income. Now, this dividend income, students, is taxable. This dividend income, students, is taxable, irrespective whether earned by investor or dealer in shares. What are you going to write? Taxable irrespective whether earned by whom? Investor or dealer in shares. deemed dividend is taxable, irrespective whether it is earned by an investor or dealer in shares. Okay. Whereas interest income, students, interest income, this interest income, taxable only if not chargeable under PGBP. Only if not chargeable. Only if. This is if, students. So dividend is taxable irrespective of who has earned. So, like for example, I'm a dealer in securities. I earn the dividend primarily. So even if I'm a dealer in security, students, if I earn the dividend, it will be charged under the head IFOS. This is a specific charge. For dividend, they have made exclusive charge only under one head. They don't ask the question. The way they are asking the question for interest income, what is the question that they are asking? They are asking the question that check out whether this interest income, can that be chargeable under the head PGBP or not. Only when it is not chargeable under the head PGBP, that the interest income will be chargeable under the head IFOS. Isn't it? But for dividend, they don't ask this question. They only say dividend includes deemed dividend chargeable under section 92. They don't ask you the question that if it is chargeable under the head PGBP, then go to PGBP. If not, then IFOS. They don't say that way. And hence, dividend is exclusively taxable in the hands of the SSC only under the head IFOS. So in my example, a person who's a dealer in securities, he will earn dividend. Then in that case, though logically you may feel that, sir, it is PGBP, but it will be chargeable under the head IFOS for him. Before the break, we did that security question. Na? In fact, I was asking, Yogendra answered that question. That question was about computer income under the head IFOS and capital gains. In that, there was a security which was received as a stock in trade and sold as a stock in trade. In that case, there was the sale on the securities held as stock in trade was chargeable under the head PGBP. But the same particular dealer in that question, I think was Mr. A. In that question before the break, if Mr. A would have earned in between dividend, then that dividend would be charged under the head IFOS. Though the sale of security held as stock in trade is chargeable under the PGBP, the dividend which is earned by him in that context would be charged under the head IFOS. What about interest, students? Interest, what will happen? If I, as a dealer of security, if I'm earning interest, so you will say that interest income will be charged under the head PGBP. Because IFOS carves out that exception. IFOS says what? That if it can be charged under the head PGBP, go to PGBP. If not, then only IFOS. That question is asked only for the interest income. Is that one clear to all of you, students? Let me give you one example.
Sorry.
I'll give you the legislative history later on. This thing, just because I'll skip that particular thing. Case law is coming in my mind. I'll just ask you a question straight away. Otherwise, I'll skip that particular case law. One question, students, very quickly. May 26 question. Adjustment. The SSC students, pay attention, students, before that case law slips my mind. The SSC has given a bank guarantee. Bank guarantee was given for business. Okay. Remember, many tenders and contract that you have to get from the government. First, you have to furnish some bank guarantee. Only then the tender would be given in your favor. They want to check out whether you are a person of means or not, whether you can execute this project or not. Therefore, they ask for the bank guarantee. So SSC has furnished a bank guarantee. To furnish a bank guarantee, students, you have to deposit the money with the bank. Once the money gets deposited in the bank will furnish the bank guarantee to the person to whom you want to issue. SSC furnished the bank guarantee, and accordingly he got his contract from the government. Now, because SSC deposited the money in the bank to get the bank guarantee, in that money which got deposited, he earned the interest. He earned what, students? The interest income. Question therefore was whether that interest income will it be charged under the head IFOS or not. The question is whether that interest income, students, can that be charged under the head IFOS or not. What is your take?
Sir, I think
It
it
will
will
not
be under
charge.
PGBP.
Okay, why you say so?
Sir, because bank guarantee is mandatory for bidding for getting the contract. So he has deposited. So it is in the course of for furtherance of the business. So it will be considered in PGBP.
Okay. Radha, what is the reason?
Uh, yes, sir. Same, I will agree with Yogendra that it will not be charged under IFOS because for the business only he has done. And I also remember one case law, sir.
What is that?
I think it's is it a NCDC case? Are you talking about? As far as I remember, but it was not in the course of his business. Here it is in the course of business.
True. Here it is in the course of business. Very true. Good comparison. Kanaya?
Sir, I agree with both of them because it is without depositing the bank guarantee, they cannot do the business. So for doing the business, they have to incur that guarantee. They have to, and for that, if any interest accrued on the same, that will be treated as accruing in relation to the business and ancillary to the business.
Very
So
good.
that would be taxable under
So
PGBP.
happy to know, students, that you are developing that reasons, because in this is a question number one, adjustment of question number one. And in question number one, students, you have to give this reasons that you people are saying. So what do? You do the adjustment, add or less, whatever you do, and then you give the reasons why you have done this. So the best part or the most satisfying part right now is that you people are developing the reasons, which is so important in CA final to really score good marks. So it is not only knowing this head, but developing the reasons why you are saying so. That's such an excellent particular part. Just keep it up, students. Your good work that you people are doing in terms of your revisions and all. Just keep up that. You are on the track. Okay. So now, students, just I don't have to add anything. Answer is indeed it is chargeable under the head PGBP. The reason is that this deposit was because of business necessity. Do you all agree? This was a business necessity, or whatever you have said, students. It is not an independent that I have made a deposit, I want to earn interest income. It was because of a business expediency or a business necessity that I have to put this deposit to get the business contract. And hence, this interest, if I have earned, has a nexus with what? Although a distant nexus, rather, you got it right. NCDC, though the NCDC was asking for a close nexus. Okay, this is having a distant nexus. So, this interest income, which is earned out of the deposit given for business, it is an incidental business income. And if it is an incidental business income, will it be charged under the head PGBP? Answer is yes. Answer is yes. So students, just keep this distinction in mind, because dividend, irrespective of who has earned, IFOs. Interest, in that case, is conditional in this regard. Now students, quickly, before, again, there are a couple of things which is there. If I can just target a question to all of you, but let me first, before I target that question, and it slips my mind, I'll just first quickly run through that section. Dividend, students, each dividend that you see, section 240, the dividend, students, that you see in section 240 are independent to each other. Students. So therefore, students, what you do right now in this case is that you just read only this A, B, C, A, B, C, D. Only this much you read, students. Don't read the second part. What is dividend and how much? That right now, I just don't want to influence you. Just read the particulars, the transaction part. And today we will finish E, the most important one. Apart from the C, which we have discussed, primarily the other most important is this E. 240E is what we will target right now. But just for a time being, A to E. Just read it out. Maybe you will not understand a couple of things. Doesn't matter, but just read it. Make yourself familiar to the terms that has been used. After that, we'll do one by one.
So do we need to read E?
Or E, we'll read it together, students. E is what we are going to target now. So maybe a couple of sections you may not be clear. Don't worry, we'll be touching upon them. C, students, we have discussed already in the head capital gains while we are doing liquidation of company. The portion of the asset or the money which the shareholders receive, on that first amount or first portion goes for dividend under section 240 clause C, and the remaining portion of the money or the asset which has been received by the shareholder on account of liquidation, the remaining portion is referred as full value of consideration in the hands of the shareholder. That is what we have discussed there also, and we have done some questions as well on that. We do not 240E over here. This is the second big one. Now, what exactly it is, students? First of all, herein, this is a deemed dividend case. This is the students' deemed dividend case. Just a second. Here, students, they say what? That it is applicable for the payment made by whom? It is applicable for the payment made by a closely held company, students. What is this closely held company means? Means a company in which public are not substantially interested. That is what will become the closely held company. So a company in which public are not substantially interested, in a simple but private company, students. A private company is giving loans and advance. To whom it has given loans and advance? To whom it has given loans and advance? 1 or 2 or 3. This is how you should remember it. 1 or 2 or 3. So either the loans and advance has been given to in first category or in second category or in third category, it will be considered as deemed dividend under 240E. So what is 1? 2, it is given loan to whom? Loans or advance to whom? To a shareholder who is the beneficial owner of shares. A shareholder who is the beneficial owner of shares carrying not less than 10% of the voting power. The shares not being the shares entitled for fixed rate of dividend, meaning thereby this voting power student means, in a simple word, equity shareholder. In a simple word, the fixed entitled of fixed rate of dividend, these are for a preference dividend which are being given generally at a fixed rate. So in a simple word, equity shareholders. So, supposing Mr. A is an equity shareholder of, say, XYZ Limited, and Mr. A's voting power is, say, 12% in that company. And during the tax year 26-27, the company has given, say, a loan or advance to Mr. A. Since Mr. A is having the voting power of how much, students? Minimum 10%, not less than 10%, students. See, the language has been used. So greater than or equal to. You should remember like this, huh, students? This is very important because when we write the provision, at that time we will write in excess of 10%. Not all the sections of such nature you will have to remember everything greater than or equal to or greater than, like that. Not all the section, but some of them. This is one among them where you should not go wrong. So it is what, students? Is who's beneficial owner of shares carrying not less than 10%. So minimum 10% of voting power means greater than or equal to 10%. In this case, Mr. A was having 12% voting power in XYZ Limited, and XYZ Limited has given a loans in advance to Mr. A. Accordingly, in the hands of Mr. A, being that shareholder, it will be considered. And this Mr. A, I will refer him as what, students? Mr. A now, in my example, I will refer him as such shareholder. What is such shareholder? Such shareholder means a shareholder who is having at least 10% of the voting power in that closely held company. To that shareholder, point number one says that to that shareholder, if I'm giving a direct loans in advance, then in the hands of such shareholder, which is in my example Mr. A, in my example who it is, Mr. A, it will be considered as deemed dividend and accordingly will be taxable under the head IFOS. Accordingly will be taxable under the head IFOS. Okay, let's see point number 2. Now, this is a very direct loan. Direct loan. Now, Mr. A, he is a bit clever. He is trying to manipulate the things. Mr. A, instead of taking the direct loans and advances in his hands, what he is doing is that he is receiving these loans and advances. Mr. A, who is a such shareholder of XYZ Limited, instead of receiving a direct loans and advances from the company, what he is doing, he is taking these loans and advances in the name of a concern. In the name of a concern, say for example, a partnership firm, in which he is having a substantial interest. In which what? He is having a substantial interest. You'll say, sir, what is substantial interest? 20% or above. 20% or above. Substantial interest, students, is 20% or above. So he is taking not the loans and advances in his name. He says to the company, make a check of loans and advance in the name of ABCN company. In that ABCN company, a partnership firm, I am having, say, at least 20% of the interest in that partnership firm. So now what happens, students, in this case? In this case, he's trying to avoid a direct exposure of deemed dividend. Will he be successful? No. Point number 2, students, targets this sort of an arrangement. Point number 2 is targeting this sort of an arrangement, and Mr. A, he is the one who has made this arrangement. So whether Mr. A will he be successful? No. Even in this case, where the company, the closely held company, when they give a loans and advance to a concern in which such shareholder is having a substantial interest, it will still be considered as a deemed dividend. In whose hands, students, it is a deemed dividend? In the hands of the shareholder. So he was trying to avoid a direct exposure of deemed dividend by diverting a loans and advance to a concern in which he is having a substantial interest. He will not be successful. Mr. A, who is having 10% or more of voting power in that company, he will still have to face the deemed dividend provision of section 240 clause E. It will be taxed under the head IFOS. In the hands of whom? In the hands of Mr. A. And in the third case also, instead of a concern, he says that, say he is trying to say, in this case, say Mr. A has found Mr. B, and he tells Mr. B that, look, Mr. B, I have to pay you something. Instead of, what I'll do is that I will tell the company to pay you on my behalf. So Mr. A is getting that deemed dividend payment. Sorry, he is getting that loans and advances from XYZ. In whose name? Not in his name, but in the name of Mr. B. But that Mr. B is receiving on behalf of Mr. A. Whether in that case also deemed dividend provision, will it be applicable in the hands of Mr. A? And the answer is yes. So they are trying to ensure that Mr. A, who is successful enough or who is powerful enough to influence and extract the money from the company, which otherwise is not possible to a normal shareholder, they have said that nothing done. Such loans and advances, if at all, Mr. A being powerful enough. What is that powerful enough means? Mr. A is holding minimum 10% of the voting power in that XYZ Limited. This Mr. A will have to suffer the consequence of Section 2, Clause 40E, whether he takes loan or advance directly or whether he takes loans and advance indirectly. Indirectly is point number 2 and point number 3.
Sir, even though if this can also get failed now if on the name of his spouse he takes.
That doesn't matter. Point number 3 will come into play, isn't
Okay,
it?
like okay, then also it will come. Okay, yeah, got it.
Point number 3 will come into play. On his behalf, he is getting it. Fine. So that is how it will come into picture.
Sir, I
And
have a
sir,
doubt, sir.
Yeah, yeah. Well, although I have not finished the entire explanation, but still you people can ask the query.
sir,
Sir,
my
like,
Uh,
okay, you can continue. I'll ask.
sir, my confusion is the point. The closed-rail company is giving in form of loan or advance. So we are treating to such shareholder as a deemed dividend.
Perfect.
But what if in further years he will repay amount? Can we reverse this income?
That is the point. Got it. So this is the point. So what Yogendra is saying is that, sir, what if this is a case of a genuine loans and advance? Genuine loans and advances. So they say that no, you as a shareholder, in your capacity as a shareholder, you are influencing a company. Can you think of any company, students, where a shareholder can extract loans and advances? And the answer is no. In this case, if you want a loans and advance, go to the bank, take the loans and advance from him. You are successful enough. See the kind of the strict provision that this section is, section 2 clause 40. You are successful enough to get this loan, and that too in the capacity of a shareholder. You are getting the loan from the company. That can happen only when you can influence the company to give you the loans and advances. And therefore, this kind of payout is not an ordinary or a normal loans and advance. This is because of you being a powerful shareholder that you can take this money from the shareholder. Sorry, you can take the money from the company as a loans and advance. This is not a normal transaction. And hence, we will characterize this amount of loans and advance as a dividend payout.
And sir, the second part of question is, what is the implication
So
when we
let me
repay the
complete your
loan?
answer. Let me come, because I think in the YouTube students would also be seeing. So let me complete. So in the subsequent year, as you said, sir, if I repay it, we will not see in the subsequent year. Even though this may be a genuine loan, a shareholder cannot take a loans and advance from a company. An employee can take. That is possible. That is a normal particular thing. There would be an employee policy, company's policy to give to the employee. But the owner cannot take what? Loans in advance. That owner can only be recipient of what? The dividends, which is the distribution of profits. That is the only entitlement as of a shareholder. And that is the reason why, if a particular shareholder is powerful enough to influence the company to give him a loans in advance, then we don't consider this as a normal loans in advance. We will characterize this amount as a dividend. Got it? Yeah. Continue. Yes, please continue.
Sir, actually, I got something.
Or else let Kanaya ask and then maybe you can think of it.
Yeah.
Yeah,
Can I
Kanaya, you can
you
ask.
ask?
Okay. So, sir, I have two questions, sir. One is, if company is an investment company or banking company and they provide loan to their shareholder as well, in that situation, would it be applicable in that situation also? And the second one is, sir, if I am a shareholder of like 5 to 6%, and my wife and children also having some shares, and accumulated number of shareholding is more than 10%. In that situation, whether this provision will applicable?
We'll see certain exclusion herein. What you're asking is something like aggregate. Can we do the aggregate? Is a query. Aggregate of your relatives. Is such relatives mentioned over here? There are some explanation. That's the reason why I thought just to explain it. Let's me complete it. So let me first complete this entire thing, and I think you will get your query in the meantime itself, whether these situations are being covered or not. Okay, so we'll do that because one situation is covered, which we will see a trade loans and advance, which we'll discuss it. But let me come back first. Let me complete this particular part, and might be after that uh, some refined queries also can be asked. So because I was in the middle of my discussion, let me come students straight away to this some part of accumulated profit. Just a second. What is not a dividend, students? Let's read this one out. And in this only relevant point, I want you to read. Point number 2, students. Every one of you, read carefully. Only point number 3. Only point number 2. Got the answer, Kaniya? So,
Yes.
if an advance or loan is made to a shareholder or to a concern, in the ordinary course of business where the lending money is a substantial part of the business of the company. So this is my particular, I am a lending company, primarily in this case. This is my job to give this thing. So in the course of my business only, I have given this particular loans in advance. So therefore, this for me, everyone is same, whether you are a shareholder or whether you are the simple, that is my business. So therefore, in such particular case, it is not considered under this particular category of deemed dividend.
Sir, but one thing, sir, if the shareholder receives the discounted rate of interest,
How
the
come?
loan having the discounted rate of interest means the lesser than the normal rate of interest. So in that situation, the differential amount would be treated as dividend.
The means because he happens to be a shareholder in that context. That is what you're saying, na? In this regard.
Yes, sir. Yes, sir.
Whether that particular thing will it be considered differential income, the amount of interest that he has to pay,
Right.
will this be
Less than the
considered?
market.
So what you're trying to say is that whether the fair market value is there or not in this regard. The
Suppose,
FMV
sir,
value.
suppose the interest rate, market interest rate is 10%, and the shareholder received the loan at 5%.
Mhm.
So, eh, so in that
The
situation, the 5.
No, that will still be, say for example, if it is my business particular this thing. So there are some special provision which is relating to the related party transaction, which we need to have a look whether the related party transaction does it exist. Here the answer is no in this particular context. The reason is this that in this case, see if it is in my course of the business, then in that situation, primarily in that particular situation, you will not force me to decide what is. I am not a normal particular case of a person who's in a like a looking into the market rates. I will have to decide my own selling price. So if in the course of the business, if see in this case, here the language that has to be considered is the in the course of the business. And that course of the business should be in the ordinary course of business. So what you are trying to say is that you cannot decide the market price in this context. However, the assessing officer can still pull the trigger by saying that this, if it is in the ordinary course of business, that to others also you are giving at 5%, then we will accept it. But only to him that you are giving at 5% and not to the others you are giving at 5%, then in that case, he will say that you are not doing it you are not giving this loans in your ordinary course of business. So how do I establish an assessing officer or income tax department? How they will establish that this is in the ordinary course of business? By checking out whether though the market rate is 10%, but he is giving loan at 5%, did he give this 5% to others also, who had no relationship with this particular company? And if the answer is yes, 5% of interest was charged to other person as well, then it will have to be, he has to accept it, that it is in the ordinary course of business. But only to this shareholder that the special treatment has been given, not to the others, then it is not in the ordinary course of business. Then in that situation, the benefit of this exclusion will not be available to the shareholder. Then he can say that you are influencing the company because you are having 10% or more of the voting power in that company. Did this answer to you?
Yes, sir.
One more point which I just want to share with all of you right now, straight away, one circular, students, so that this 222E is taken care of at the very 240E, sorry. 240E is taken care of at the very outset. Students, this particular part. Circular number, this one. Now, I need not tell you, students, that the old circular are also applicable in the new act. I think that is something that you people would have referred in the initial class itself, the basic concepts, isn't it? So those things already has been taken into account. So now, students, the old circulars are also applicable to the new act. Now, supposing, students, this shareholder is also like a contractor and the company wants to do a repair work. This particular 10% or more voting power shareholder, he is also a contractor who does the repair work, and the company wants to get the building repaired. So obviously they have hired him to do this building repair job, and the contractor says that I will do it, but I require an advance. So the company gives an advance, but then the company knows what? If I give them the advance, then this shareholder will have to face the music of section 240E. It will be considered as a loans and advance given to this shareholder who is having 10% or more of voting power in this company. So 240E would be applicable in this contractor shareholder's hand. Will it be applicable? This circular therefore becomes very important. What they say is that trade advances in the nature of commercial transaction do not fall within the word advance and are not deemed evident. So in a simple language, students, when we talk about loans and advances, this advance will not include trade advance. Other than trade advance, any other loan and advance given by the company, either directly to the shareholder or to the concern in which such shareholder is having substantial interest, or to any other person on behalf of such shareholder, in any of the three cases, it will be considered as deemed dividend under section 240E in the hands of the such shareholder. And it will be taxed under the head IFOS. Is that point clear to all of you, students?
Sir, whole loan amount would be taxable, right?
Entire amount.
Okay, sir.
And what Yogendra said in the first query, sir, what if I repaid the loan later on? Still it will be taxable. Subsequent repayment will have got no relevance at all. Okay, so therefore this is the point. Now, students, one important amendment as far the dividend, although it is applicable for entire dividend, one very important amendment, students, as I want to share with all of you. Very important amendment, students, of Finance Act 2026. Or else this particular part, I'll do it towards the end, amendment particular part. So, students, over here, let me first come to the questions, relevant question. I'll just come to a relevant question straight away. Students, have a look. Illustration 2. Many a time, students, this has been targeted in the examinations. Huh? These are examination questions. Dhaval manufactures customized kitchen equipment. He's a managing director of RF Private Limited and holds nearly 65% of paid up share capital. A substantial part of his business is obtained through RF Private Limited, and for that purpose, the company passed on to him the advance it had received from its customers, so that he could exercise the job work entrusted to him. Which means that, students, in this case, what does it mean? Dhaval manufacturer is what? Dhaval is a subcontractor. The company is a main contractor. So the orders which the company is receiving, they, for some portion or a substantial portion, they give it for job work. Get this thing done. This is what it is the case. Now, obviously, to do the job work, Dhaval require advance. So whether that advance which has been received by Dhaval in this context will be in the nature of a trade advance? Yes. And if it is in the nature of trade advance, whether 240E, will it be applicable as a deemed dividend in the hands of Mr. Dhaval? Answer is no. Answer is no, students. So the advance is passed to him to enable to execution of work entrusted to him. It is therefore money transacted to give effect to the commercial transaction and not as a gracious advance enjoyed by reason of shareholding. So that is to execute the job work. So therefore, it is in the nature of trade advance. And hence, as per the CBD circular number 19/2017, it will not be considered as deemed dividend. So loans and advance will exclude trade advance. Let's see. MNO Private Limited is a company in which the public are not substantially interested, which means a private company, we can say that way. K holds 15% of its equity shares. The accumulated profit of the company as on 1st of October 2026 were 10 lakhs. On 1st of October 2026, the company lent rupees 1 lakh to K by an account paid bank draft. The loan was not connected with the business of the company. K repaid the loan by an account pay bank draft on 30th of March 2027. Now, Yogendra, your question only. Whether subsequent repayment will that provide him the relief from the applicability of 240E? Subsequent repayment in the same tax year, will it provide him the relief from the applicability of 240E? Answer is no. 240 is still applicable. Okay, because he is receiving this loans and advance in the capacity of he being a shareholder and not in the ordinary course of business. Let's have a look to the next question. So you can see these are how many questions are this. You'll find mainly 240E only targeted in the examination, mainly in deemed dividend. Illustration number 4. Parimal, managing director of Heavens Engineering Private Limited, holds 70% of its paid up capital of rupees 20 lakhs. The balance in general reserve as at 31st of March 2026 was rupees 6 lakhs. On 1st of April 2026, the company gave an interest-free loan of rupees 5 lakhs to its supervisor. Students, on 1st of April 2026, the company gave an interest-free loan of how much? Rupees 5 lakhs to its supervisor, whose salary is only 4,000 per month. And he's getting how much? 5 lakhs. And on 15th of April, after 15 days, the supervisor advanced the same amount to Parimal. Can it hit the third particular point which we've discussed in this case?
Yes, sir.
Because what he would have said, Mr. Parimal would have requested his supervisor that, look, boss, if I get the loan directly, then in that case, it will be a deemed dividend. Do one thing, you take the loan, you are an employee, and you can get a loan also from the company. And this will look like a genuine transaction. So you take a loan and then you pass it on to me. And by virtue of this, and they are emphasizing this, see, his salary was only 5,000. Loan given is 5 lakhs. No justification. How this has happened? Because Mr. Parimal was influencing his shareholding 10% or above. Because of that influence, in that context, he was successful to give this loan to this supervisor having only 4,000 per month salary, and then obviously in turn get that particular amount back from him in this context. So therefore, yes, we will have to say, going by the facts, that this particular person is exercising its shareholding power, which is 10% or above, voting power, and accordingly, it will be considered as deemed dividend, taxable in the hands of Mr. Parimal.
Sir, I have a couple of questions. Can I ask, sir?
Yeah, you can ask.
Sir, if his salary would be around more than 25,000 or 50,000, so in that case also we consider the same thing.
Again, very subjectively, it will be a very subjective. That's the reason why in the examination, when they are asking this question, they don't want to have any doubt in the mind of the students, isn't it? They don't want to have any doubt in the mind of the students. See this 4,000 per month salary employee. He is the one who is getting a 5 lakhs of what loan from a company. Just think of it, whether he will be in a position to repay it in his lifetime or the balance thing, maybe not. And therefore, whenever a loans are being given, there is something like a 2 years maximum or 3 years maximum that the repayment could have been done. In this 4,000, who will do the repayment? But when you increase the amount of say 25 or 50,000, then might be I may be having a doubt that yes, there could be a genuine reason that he would have to take the money from the company, and the company as a policy can give 5 lakhs because his salary is very high. So therefore he could get that much of the loan. So now there could be a doubt in this context. And then
So,
what
sir,
he does from his salary later on may become immaterial if he is a very high paid employee in that scenario.
so sir, in the practical life situation, sir.
Hmm.
So, sir,
In the
like,
practical life situation, if you ask, then in that case, it has to be established. AO will have to have the burden to establish that this was an influence, that the shareholder was successful to get this loan to the supervisor. Because first is the most important thing is that whether the company can give such loan to this kind of a person who is an employee drawing this much of salary. That is the most important aspect. If he said that I am capable enough, company has a policy, and if everything is within the four corners of that particular company policies, I think that it will have a narrow escape. It may not get 240E applicability if he is a high paying employee as against the 4,000 per month employee which we are discussing in this particular question.
okay, sir.
Okay.
So here in this case, manipulation can be done.
Yeah, could be done at a higher level. Yes.
Yes, sir. Thanks, sir.
Illustration number 5, students. I think this is a repetition only. Illustration number 5. No, it's not a repetition. Just a second. Let's have a look. Read this illustration 5. Let's read illustration 5. Mr. Santanam, holding 25% of voting power in VKS Manufacturing Private Limited, permitted his own land to be mortgaged to a bank to enable the company to obtain a loan. To enable the company to obtain a loan. So what is happening, students? He is holding 25% of voting power in that company. He permitted his own land to be mortgaged to a bank to enable the company to obtain the loan. Okay. He later requested the company to release the property from the mortgage. The company failed to do so, and in order to retain the benefit of the bank loan, it gave him an advance of rupees 10 lakhs authorized by a resolution of board, meaning thereby what the company, see, company said that, look, boss, release this particular, I want my land back. I helped you because the company was in dire need of fund. So I happened to mortgage my land. And then the company was successful enough to get the loan from the bank. Now the company has received the loan and some time has passed. And then later on, he requested that the company, now please release that property from mortgage, meaning thereby, please pay off this bank so that my property get released. The company could not pay off the bank. They have failed to do so. And in order to retain the benefit of the bank loan, it gave him in the advance of 10 lakhs. They said that, look, boss, we know that this is there. So we just give you 10 lakhs so that we could retain the benefit in this regard. And for that, they have passed the resolution. The accumulated profit on the date of advance was 50 lakhs. Why they are emphasizing on this accumulated? In the previous question also, students, they were emphasizing on accumulated profit, isn't it? Why they are emphasizing on accumulated profit, that I will disclose it in the next class. But just now, in the substance of that section, I just want to remain and I want to complete this particular section. So the accumulated profit on the date of advance were 50 lakhs in this regard. In that scenario, students, in that situation, the officer proposed to treat rupees 10 lakhs as deemed dividend under section 240. Is the proposition correct in law? What do you feel, students, just by looking at this?
No, sir, it is not correct. I
Why?
think so. Sir, this is actually, if we check the provision of 240 clause E, in all three cases, it is benefited by the shareholder. But to enhance the benefit to the company, they are giving this as advance, so it won't be considered as 240E.
Okay. Radha?
Sir, here I am not sure about the opinion, to be frank, because here Santanam is having 25% of the voting power. So I was thinking that maybe he can influence, right? That's why he mortgaged the property. So I am having a different view than Yogendra in that case.
Okay. And Kanaya?
Sir, what I think, sir, as the person has given land for loan to the company, so company was in dire need. So for that purpose, they have taken the loan for the survival of the company, and they are returning money not to the Santanam or like the person. They are returning to set off the loan or the interest or principal part, so that the loan can be saved. So
True.
in that situation, it should not be treated as dividend, rather
So,
than it is a kind of compensating of capital part.
so in a way, if I have to formulate this, what Kanaya is saying is that here, first of all, it is not a case where the company has given a direct loan to the shareholder, but just because he happened to hold the shares of the company. This is not a direct case. There was a background first. The advance of 10 lakhs that was given by the company to Mr. Santanam had a rich background. There is a story behind this. And what is the story? That first, Mr. Santanam helped the company to get the loan from the bank. And it was not a case where where the company takes the loan from the bank and pass on to Santanam. So it is not a case of 240E clause number 3, where the loan has been given on behalf of this particular person. So that is also not a case which we can cover it up. The loan which the company obtained, the company wanted to use that loan for its own business. But later on, because That loan was on the mortgage of a land which belonged to Mr. Santanam. Santanam requested the company to release his land, which means that they will have to pay off the company. Sorry, they have to pay off the bank. The company didn't have the funds to pay off the bank and release the mortgage. So what they did for buying time to use that loan which they have obtained from whom? From this particular person. They've said that we agree to give you an advance of 10 lakhs. So is this advance in relation to his shareholding? Because everywhere we were trying to, whenever we were discussing 240E, we were trying to have a linking or a relationship with his being a shareholder. He is extracting the money. So is this 10 lakhs being extracted as an advance? Is it been extracted as a because he is having a 10% of more voting power in that company, or it was because of his land that he mortgaged and he wanted it released, but the company wanted to hold on that land and wanted to hold that particular money. Therefore the company had to give them the advance. The relationship is not with the shareholding. The relationship is that with the usage of the mortgage that the company is enjoying. And because of that reason, students, in this particular context, here the advance was given. Just have a look, students. Here the advance, next paragraph. The advance was given in lieu of the non-release of shareholders' personal property from mortgage. So it was not given in lieu of he being 25% shareholder in that company. This is how you should distinguish. Is the advance given which was in lieu of that 25% shareholding in the company, or it was given in lieu of that the company was not able or capable to release the personal property from mortgage? That was the reason. And therefore, this advance protected the interest of the company and was not gracious. The proposition of the AO is not correct. So simple one particular entire thing. Is this advance given in lieu of shareholding, being having 10% or more voting power? Is that the reason why this advance is given? No. This advance of 10 lakhs has been given because the company wanted to hold that loan. But this loan was on the mortgage of the personal property of this shareholder. And this shareholder wanted the release of that particular mortgage, which they didn't want right now because they wanted that loan. And hence they gave him the advance of 10 lakhs. So this 10 lakhs was not in the lieu of shareholding. This 10 lakhs was in lieu of holding on the advance. Is that point clear in this context or not? Radha?
Sir, actually, indirectly, the nexus is there now. Even though its shareholder is a owner. That's why I was having that point in my mind.
Indirectly, as in like it doesn't satisfy that way because see here every particular A in the capacity of see here in this context, if you see very carefully, the loan was not taken by the company for Mr. Santhanam. If you could get this kind of a combination that the loan was taken by the company for Santhanam, then you may say that 240E may be applicable. But is this loan taken by the company for Santhanam or for itself? It was for itself. So that
Yes.
relationship that you are trying to establish is closed.
Sir, for itself also, ultimately, if company is benefiting, then shareholder will also benefit.
No, that relationship very very distinct because company and the shareholder are distinct persons. Solomon versus Solomon, which is already we know. So that you are trying to see through the company and see where the benefit. Ultimately, you can't have this particular this thing wherein you are seeing through the company and going to whether ultimately the shareholder will be benefited or not. That way, otherwise, even the company is doing a manufacturing. For the manufacturing also, they may take a loan. Then one can argue that that loan ultimately the shareholder is beneficial. Why? Because once they take a loan, they can do a lot of manufacturing in their business, and because of that lot of manufacturing in the business, there will be a lot of profit, and ultimately the profit will go to the shareholder. So every loan that the company may take, ultimately the shareholder will have to face 240E. That will be unjustful, isn't it?
Yeah, that means immediate nexus is being thought of,
That
not
is the
very
reason.
distant.
Yeah, that's the reason why I told you what you have to see. Is that particular company, did they take the loan and simply passed on to Mr. Santanam? Was that the case? If that would have been the case, then we would have said that the loan was, this was taken on behalf of the shareholder. If that is an
Yes,
excess that is established. So this is not the case.
that,
This loan was taken for itself in this case. And this advance was been given because they want to hold that loan. But this loan was on the personal property mortgage of Mr. Sundaram. That precisely the reason. So shareholding was not the nexus of giving the advance. The nexus was holding on the mortgage of the personal property of the shareholder.
yes, sir. Ultimate purpose is being looked upon. I got it.
Fine?
Sir, one thing I would like to add, sir.
Yeah.
Like no one would mortgage their land for the benefit of company.
That is one of the way to look at it, isn't it? Yeah. But I hope that all of you are clear with this thing. This section is very important. Should not have any
Yes,
doubt.
sir.
Although there is a couple of points like accumulated profit. If you see here also in the previous question also accumulated profit reference was been given, but I have not touched upon directly. I will use it in the next class. Fine, friends. In the next class, friends, we will be hitting the new topic also in this context. It's a very small topic. Only request, friends, if supposedly by Monday you will be getting this notes. Okay, because it's weekend now. So can you just read this part number 3? Because part number 3 is a miscellaneous income like lottery winnings and all. So this is a segment number 3 is a miscellaneous item. If you get a question in the examination, it will be first and second part only. Okay, it's not that part number 3 we will not be dealing with it. I'll be doing that part 3 also. But very quickly I can happen to do it if you people just read it once. Okay, if you get the notes up by Monday, students. 3 parts.
What
I
is
told you
this
already.
section?
3 parts I told you. One is the deemed dividend that we are doing it right now. Another is the gift tax. The second one, which we discussed already. The third one is the miscellaneous segment. I'll just show you where it is. After gift tax, you will find it. After the gift tax, you will find it. That's the third segment. I'll just show you once. This interest on compensation, enhanced compensation, remember in capital gains, we discussed all that thing. Casual income, lottery winnings and all. Segment number 3. Segment number 3 starts with casual winning. Students, 3.1. Segment number 3. If possible, it's not that you are not aware of it. In Inter-C also, you people have done it. Because there is not much enriched discussion which is there. It's just you need to know that these are the income chargeable under the head IFOS. Fine, students. Just deal with it. Read it once so that we will be in a position to finish it off, primarily this segment quickly, and we move to the next topic which has been there. Fine. So in the next session on Tuesday, students, first we are going to complete the balance portion of dividend. There are still a couple of important points that is to be discussed primarily. All the question, however, is either in 222C or 222E. 222E we discussed today. 222C we discussed in capital gains. Fine, students. But nevertheless, we will cover up the remaining segment as well of the dividend. Fine. If Monday, students, you get this notes, ensure to, in the Monday evening, primarily ensure to just go through it once, this third segment, so that we will wrap it up fast, this particular topic. Fine.
Yes, sir. Sir, you will upload it not today.
Today, not today, Monday. Rather.
You will upload Monday. Okay.
Means the
Fine.
institute will upload it.
Okay, sir.
Okay. Okay, Radha. Yeah. Take care.
Take care, sir.
Kaniya?
Thank you.
Yuvendra?
Sir, a query that when we are discussing 240E, I stopped at one query, right?
Yeah.
I have messaged you because if I forgot to reconcile that if we consider as a deemed dividend to the shareholder and he paid tax on it, does he is not liable or not to repay the such loan or advance?
Again, repeat the question.
Sir, example, I am the shareholder, sir. who has more than 10% of voting right. I have drawn a loan from the company, so it is treated as a deemed dividend under 2 subsection 40 and clause E, and I was charged of tax while filing income tax.
Okay.
So from my perspective, I have that such income was such deemed dividend was charged as my income. So what I am saying is I am not liable to return this amount to the company.
Okay. No, it's not that way. You may return it, you may don't return it. That's a different thing. The government is not interested to know on that. Obviously, if it is even if it's a genuine loan, you may have to return it at the end of the day. If it is not a genuine loan, doesn't matter. The government has already got the tax from you. That's the end of the story as far as the government is concerned. Subsequently, if you repay the loan, government is least bothered.
Yes, sir. If I have paid tax, then
Yeah.
company asking for repayment, I can say to the company that I already paid tax on by treating it as an income, so I won't pay.
No, that will not happen. This is a different equation because that's a commercial transaction. No? See, this is the two things. One is the commercial reality, and another is the tax. Another is the tax reality. So, a commercial reality, if there is a contract which has been made between you and the company, and as per the contract, you have to repay it. You cannot take a position that just because in the tax law I was being taxed, therefore now I will not return the money. So that money does not belong to you. So now belonging the money and all these are the commercial side that you are talking about it. From taxation point of view, we only are focused or concerned with whether the tax is getting attracted or not in this particular case. That's a limited angle. That is it. Like for example, in capital gains, just now we discussed, stamp duty value is what we take as a full value of consideration. If it goes beyond 110% of the actual consideration amount, supposingly, in this context, you cannot say that, look, 110% of the cost is what has been given in this regard. So, seller has paid, say, for example, in this context, seller is saying 110% is this say case, which I have paid already in this context. So, because a separate value has been taken, Rohan, just a second, Rohan, I'll answer you. Separate value has been taken. That actually does not mean that your commercial transaction was at separate value. Your commercial transaction maybe would be worth rupees, say 12 lakh, 13 lakhs. In this case, taxation works on a different way. There are anti-avoidance provision wherein they take up an artificial value. What they are focusing here is that you as a shareholder was in a position to influence, you got hold with that particular loan. Others are not. So therefore, now once you are successful and you got hold with the loan and the tax was being paid to you, now government of India from tax point of view, they will say, now it's between you and the company to see whether the company wants to recover the money from you or not. We are not interested. We already got the tax from it. But you cannot say to the company that because that the tax has been imposed on me, now I'm not going to pay. Income tax law does not give this sort of a defense. This is a contractual obligation. So therefore, a position taken under the income tax law does not override the position under the commercial contract and vice versa in this context. Both are in a separate domain in this case. One is a commercial particular law, a contract act that will prevail. Another is the income tax law. These are two separate legislation. Does contract act says that if an amount is considered as an income there, therefore you are not supposed to pay? Does the contract law say so? And the answer is no. And if the contract law doesn't say so, so you cannot say that because I have paid the tax here, I will not repay you the loan. But as an influence shareholder, you can definitely say so. But that is not the concern so far as the government of India is concerned when it comes to taxation law. Taxation law is clear. We have to collect the tax, we have collected it. What happens between you and the company, it is your lookout. As per the terms of the loan arrangement, you will have to take a call.
Okay, sir.
Rohan, one question you asked. The question that you have asked is, in last example, 10 lakh received by shareholder for mortgage of land, will it be taxed under the capital gains? Mortgage of land. No, here understand one thing, he has mortgaged the land. The loan was being received by the company. Now, in this particular context, if you see Rohan, in this context, that thereafter he received the 10 lakh rupees. Thereafter he received the 10 lakh rupees. But please understand, this was received him not as a consideration, it was received like an advance. Do you know what will happen, Rohan, later on? I'll close this particular example for you. It was, if you read the question, it was received like an advance, not as a consideration. Do you know what will happen? Once the company repays the loan, then it will happen so that they will have to also, he will also might have to repay the advance to the company. So therefore, it was not a plain case which you are trying to say that, sir, it can be charged under the capital gains. No, it cannot be. Because it has not been received as a consideration for the transfer of what? For the transfer of the land. In this case. So it was been given as a particular advance as per the board resolution. Okay, which implies this that temporary fund, Mr. What was his name? Sadanand. Sadanand would have received the amount. And then what would have happened? Then once the company repays the loan, then the asset will get released. Mr. Sadanand will have to again give that 10 lakh advance or whatever be the resolution passed. So this is not a case of a transfer that is taking place by Mr. Sadanand to the company. It's not a case of a transfer.
Okay, sir. Thank you.
Thank you, everyone. Okay. So students, illustration number 3. Oh, sorry, segment number 3. If it is possible, just go through it once. Once you get the notes on Monday. Good night to all of you, students.
Good night.
Good night, sir.
Thank
Can
you
you
for
please keep
having
revising?
me.
Good job. Keep revising it. Okay. I'll see you on Tuesday. Yeah, please.